All right, well, welcome everybody. And what is it? Episode 4 of Markets Parlay. But yeah, I don't know. What were we saying about the bond prices? Yeah, them moving. And oh, yeah, the ceiling, the debt ceiling. I don't even know. What is the US debt right now? It's pretty high, right? Let me see this.
30 trillion? I don't know. Yeah.
Yeah, but like the rate at which is growing. Let me see a graph or something.
They
Oh,
have that.
you
There's
want me
that
to share
website.
my screen by the way in Discord or no?
Yeah, yeah. I'm finishing up some stuff I gotta do and
Yeah,
then
no
I'll be
worries.
right.
I just mean like so that you can check it whenever you feel like it. All right. Let's see. US debt over time. You're gonna give me like a graph or no? Damn. Yeah, that was pretty steep.
There's a website that shows you like the real time.
Oh yeah, I have that app on my phone actually, but yeah, let me see. I mean, I don't know if you're talking about the same website, but what is the website you're
Yeah,
saying?
yeah.
It's probably
That's
easy.
probably what I'm talking about. I don't know what the website is.
USDebtClock.org.
Yeah, I think that's yeah.
Let's see. Yeah, there it is. Yeah, this thing. Oh my god, I feel like I'm on like those idle games, which is just like make cookies or something, and then your number just go up by clicking on the phone. That's what this feels like. But this doesn't have a graph. That's the thing. That's it. Just national debt, 37 billion. No, 37. What is that? Billion, 37. What? Quadrillion? No, trillion. It's gotta be trillion. Right? Am I understanding what a trillion? Okay, this is a million. 1,000 million is a billion. Oh yeah, okay. 1,000 billions is a trillion. 37 billion. $37.5 trillion. And going up at about, I don't even know, what is this? 100,000 per second or 50,000 per second? It's kind of wild to say.
Mm-hmm.
Doge clock. They added a Doge clock that is saving $5,603 per taxpayer. I
Is
guess
Doge even a thing anymore?
I think it is. It's just the mask is not there. But yeah, I mean, it should be. I don't know. You think it was just like a political gimmick, and then they're not gonna do anything about it? I mean, apparently they're not doing as much
Yeah.
as Musk would like.
He beef with the guy and then now it's like he's kind of you
I
know.
mean, I think the beef was for two things, which I think both of them had like a bit of like they were right. It's like Trump did not cut as much as you would have expected from him saying about the Doge and stuff. And then the other thing is, I think it's also like Musk got upset that Trump put that bill against like EVs and stuff. Like he took away all those subsidies or many of them. And I guess that upset him. But I feel like, I think Trump had been saying he was going to do some shit like that. But you know how Trump is, you know? The art of the
Yeah. You
deal.
heard Charlie Kirk got shot?
Oh, yeah. I mean, yeah, definitely heard that. I mean, it's everywhere. Have you
I
seen the
think.
video, bro?
Yeah, yeah, it's crazy.
Yeah, that stuff is wild, bro. Right as he's talking about it, too.
It's insane that like I think his kids were there, right?
Yeah.
Some said his
Yep.
kids and his wife were at the rally.
Yep.
Or
Yep.
is it a rally? What do you call that? I mean,
Yeah.
whatever,
I
like
don't know.
the debate or whatever.
Yeah, no, they were there. Yeah. Pretty
Shit is
wild.
insane.
Yeah, and they haven't cut the guy apparently. They cut two guys, but they said it's not them.
Yeah, the
So,
old guy was not him.
mm-mm. And then there was another guy who also wasn't. I mean, he apparently shooter was
I
200
got
yards
cat.
away, so I guess I don't know.
Yeah, but I'm
He
saying,
probably
yeah,
ran away pretty well. Okay. Well, rest in peace to the man. Let's see,
Carlito.
Carlito. Um. So we got here our stock picks, the picks of the stocks, and the sectors we gotta do are three. Let's put them here, I guess. And they are materials. Which I don't know why materials would be a whole sector. Like, oh, okay, wait, what is materials? Like extraction of materials, like mining and like lumber and things like that? Because I thought that would be more
Uh, it,
industrials, but yeah, I
I'm
guess that's what it
I'm
is.
pretty sure it's like chemicals usually. Like I
Right.
think
So,
Dow is the
hmm.
biggest company in that sector, and I think they just do chemical stuff.
So you don't think in here is mining and lumber? Because I feel like if you
Maybe
don't
I
put them in there, I'm like, then what the hell is the point of having a whole sector just for materials?
would
But
assume that mining and lumber is like industrials, no?
yeah, I mean, but then it's like, then why would you make a distinction? How would it be like chemicals, industrials? That was my thing. I'm like, what the hell's the point of having a materials sector? But yeah, that's why I'm like, it's gotta be the fact that it's like in extraction, and then industrials would be like processing of whatever you get in the extraction. Like like oil refinery would be industrials, but
Yeah.
nah, I mean both of them
You
are
know,
energy. Like, whatever.
I had a thing yesterday.
Okay.
I had like an opinion yesterday that
Okay.
valuing rates is probably super easy because
Valuing rates.
it, yeah, like real estate investment trusts.
Ah, okay.
Because like nobody really thinks about using dividend discount models IRL. And
All
then,
right.
but for rates, they're perfect because rates have to give like 90% of their income as dividends.
Yeah. So you're
So
saying,
it's like,
I see.
man,
Yeah. I
like a
mean, it
DDM
becomes.
is
Uh huh.
probably the only time where it's actually applicable to use a DDM, really, because it's like, it doesn't change that much in terms of like free cash flow to
Yeah.
dividend.
I mean, I guess it's as applicable as doing it on a dividend paying stock that is stable enough, right? Like Coca Cola. It's just like in this case, instead of analyzing,
No,
no?
that I thought about that, but it's not like because Coca-Cola doesn't give, maybe they give like half, right? Maybe their payout ratio is half, let's say, right? There's
Oh,
still
okay.
so much. Yeah, I
Like the
don't think it's
fact
more
that the
than
free
that.
cash flow can be spent on reinvesting, and in a rate you cannot do that. Something like that. Is that what you mean?
Yeah, I mean, just because like there's so little money left over because again, like they're mandated to give 90% of
Yeah.
all their free cash as a dividend. So it's like
Yeah.
there's less room for error, whereas like for Coca-Cola,
Yeah.
their payout ratio is less.
Yeah.
So there's all
Fair.
this other money that you're not accounting for really in terms of
Yeah, like the fact that they're restricted in their payout ratio means that you can just
yeah.
assume. Yeah, but then I guess the harder part becomes of figuring it out. I mean, harder. It's just like the analysis becomes what is that free cash flow, right? Because then it's gonna translate into dividends, but because now you got to figure out, the renting rates, right, of those properties, the maintenance rate, because like all those dividends are gonna come once you've done all the maintaining of the properties, the
Well, all
renting
that, yeah, but
amount,
all that,
vacancy
kind of
rates.
all that flows into like the change in rate and the change in rate of the income, which is all in the dividend. You know what I mean?
Right. No,
Like
yeah. I mean, I
a
think that's
company
why.
is theoretically healthy
Yeah.
if they raise their dividend.
Yeah. Like I think that's why they force them to do 90%, so that when you analyze a rate, it's basically as if you were analyzing a portfolio of real estate properties. Like
Yeah.
you don't really have to worry about the management company because they're supposedly just like they just act like what is it called, like a grouping or grouping up properties for your benefit. So you can just analyze their portfolio and then assume that all that money is gonna come to you as if you were an owner. Which, yeah, I
Yeah.
mean that is what it is.
Is
Yeah.
a real estate company buying more real estate? That's not capital expenditure, right? That's just, is it?
It
What
is,
is
but I
it?
think I was thinking about that a second ago actually. I'm like, how do they fund new investments? And I think they can only do that if new capital comes in. So if more people buy the rate, that allows them to have more funds to buy more property, which would also fall in line with the idea of a rate just being as if you had a real estate investment company or shares in
It
it.
is that, right? But
I
but like
think it's
let's
that.
look at agency. I mean,
I know.
agency is a little bit of a different story
I
because
already put in a
they're
stock picks because I still like them, bro. 14% dividend
yeah.
yield. Yeah, yeah.
The best thing is this is not the best thing because
Hmm.
they don't buy property. They buy MBS.
Ah, okay. Like they already buy packaged up like mortgages. Yeah, I mean it's yeah. I see what you mean.
Yeah,
Yeah,
they're like a debt investor. They're not they don't invest in real estate directly.
gotcha. All right. So O, just O,
Yeah, just so.
realty income. Yeah, I mean, but the dividend is much lower. But yeah, I mean, I guess it's because it's like they just probably have a lower margin because these people don't have any like agency doesn't have to worry about maintaining the properties, right? They just got to be really good at analyzing mortgages, I guess, right? I guess that's the risk with the
Yeah,
agency. Yeah.
and the risk in agency is a lot, bro. It's like they operate on an insane leverage factor.
Well,
They
they
have
own
like
debt. Yeah.
yeah, they have like they have 9 billion in unencumbered funds, but they achieve that by essentially having like $60 billion of debt and like $69 billion of asset of unencumbered, of assets pretty much. It's like the leverage factor is insane. I don't think O has the same leverage factor.
Okay.
But maybe they do. I don't know. I don't know if O buys their stuff with debt or if they buy it with capital or what they do.
I guess yeah. Let's get started with real estate since we're already on a run with this. Okay, so let's see. Oh,
Yeah,
let me get also Schwab's
it's Bob open,
Realty S&P 500 companies, a real estate partner to world's leading companies. Funding. Okay, it seems pretty established, which is good. We serve our clients as a full-service real estate capital provider.
Oh yeah, this is the king, bro.
The king? Oh, you mean like the king of rates?
Mm-hmm.
15,600 properties in all 50 US states, the UK, and 7 other countries in Europe. We're known as the monthly dividend company. We have a mission to invest in people and places to deliver dependable monthly dividends that increase over time. I mean, the fact that that's already in their definition, it's pretty, yeah, it's pretty nice.
Yeah, they have like 30 plus years of they've
Wow.
grown their dividend every year for
Yeah.
30 years.
Yeah, there it is. Dividend Aristocrats Index for having increased our dividend for over 30 consecutive years. Damn. I didn't even know this was a thing. I do like that index. I would like to check it out. This S&P 500 Dividend Aristocrats. Let's
Yeah,
see. Who are these?
it's like all the companies in the Dow. Well, not anymore actually, because the Dow has kind of changed, but you'll see. They don't make sense. Like Coca-Cola's there, Pepsi is there,
Mm.
um, Dow is there.
Wait, can I just...
Go to the best way to look at this kind of stuff for ETFs is
Oh,
ETFDB, which I think got bought by another company. I think V. No, but just type in ETFDB. Yeah.
oh okay. Okay.
That one, yeah, and then click whatever the ETF is. I think it's you need a ticker, bro. Oh, yeah, there you go.
Wait, is it
Is
this?
that it?
I mean, that's one of them. I
Okay,
guess these
perfect.
people... No. Okay. Didn't quite work. Wait, but didn't I just click on the... I'm confused. This is not even a search on their page? Okay. What the hell am I doing?
You gotta type the ticker.
But if I do this, this is a ticker here. Did
Yeah,
I
click
not click
that.
on that at first? Oh, maybe I didn't click on that. Okay.
Yeah, and then
Holdings. Okay.
holdings. Yep.
CH Robinson Worldwide. Lowe's. AbbVie. Archer. Daniels. Midland. Pentair. Federal. What is this like? HVAC? HVAC? Who knows? I mean, I
Maybe.
don't know why I assumed that yet. Stanley Black Decker.
Daniels Midland was on my screen, was on my watch list recently.
Walmart. They've been around that long. I mean, I guess the qualification doesn't have to be 30 years, right? They're saying they've been doing this for 30 years, right? But what is the qualification for?
No, I think Dividend Aristocrats it is 30 years.
Oh, shit. Walmart's been around for that long.
Because I think there's another thing called Dividend Kings where it's like 15 years. Like they have like names for all of them.
Mm. Wait, how would be kings below aristocrats? Anyway,
I have no idea, bro.
fair. I mean,
I know you
Coca-Cola
have the,
is not here. Or maybe these are not all the holdings? Nah, they
that's
cannot
not
be.
all of them.
Yeah, that's not all of them. Top
You have the
50.
option to export them all at the bottom.
Oh, damn. For free? No, members
Sure.
join. Yeah, but yeah.
Really?
Yeah, yeah. Set members join. I mean, at least, yeah, here, ETF database. Database.
No, but when you go to export, it
Yeah,
like,
that's when it tells me to join. Members join.
uh,
Yep. Kevin O'Leary is telling me.
oh
I
no,
chose cptfdatabase.com based on their deep understanding, focus, and leadership and tools. Reese. Do you know he worked with Musk? I didn't know that. Like when he was younger or whatever. Like, whatever. They were like co-directors or some shit. I don't even know. Or
no
just
one
partners.
cares.
Okay. All right. Yeah. Fair. Fair, fair, fair.
That's just like so weird to me, bro.
What, that guy?
Like I don't understand why he does so many ads for stuff, bro.
Well, yeah. I mean, he's like a media
Like,
personality.
are your pockets hurting that much, boo?
He seems
Put his name
desperate to
on
you.
any,
Is that the thing?
yeah, bro. He puts his name on anything. Like it's like, bro, there's no due diligence on the stuff he puts his name on. He just cares about the paycheck.
I mean, yeah, I think that is his strategy. I don't think he cares much.
It's insane, bro. Both him and the other guy, the I think he's like Croatian, Robert Herjvac or whatever.
Uh-huh.
They both like were like the faces of businesses that eventually went under for being scams. Like this guy, Kevin O'Leary, was like a big like guy in the what's that guy not Sam Altman, the guy that went to jail for like the crypto thing.
Oh, yeah.
He was like a big
Sam
like
Batman Friedman.
spokesperson. Yeah, he was like a big spokesman for that company.
Oh.
And then Robert Herjavec was like a big spokesman for like EasyJets, which was also like a scam.
Uh-huh.
Yeah, it's like I don't know.
Yeah, I mean, Tom Brady's in that list too, I guess. And was that
Yeah,
guy?
but
And
Tom Brady. The
Larry.
thing is that Tom Brady is an athlete. Like he's
No,
not
I get
like
it. I get it.
Twitter
Like,
supposedly is like a finance
I just
like a
don't think.
finance
Yeah, I don't think
guy.
this guy's as much of a finance savvy as that he says. I think he's just more of a business guy.
No,
You know what I'm
yeah.
saying? He's like a good
That's exactly what I'm
executive,
saying.
if
Yeah.
anything. You know what I'm saying? But yeah, yeah. He's not an analyst. That's for sure. Or he
I don't
doesn't
think he's
seem like
anything
that.
related to I don't think he's anything related to like the investment universe. It's like what you said, he's a
Yeah,
businessman.
exactly, exactly. He seems like a manager. Yeah, but
But
then
then it's like
somehow he's
stay
become
in
like,
your lane, bro, you know.
yeah, he's acquired this image as if he's some type of financial like connoisseur.
He's built the image,
Yeah, yeah, fair, fair. Yeah, it's not like he
you
just
know.
fell upon it. Yeah.
It's all on purpose.
Okay, we have here Morningstar just really liking realty seems. I don't think I just why it matters. No, we think of as the largest triple net rate. Triple net, triple net. I don't know what that is. A type of commercial property lease where the tenant is responsible for paying all ongoing expenses. Damn,
No,
that's annoying. Real estate
yeah, it makes
taxes,
sense
building
because
insurance, and maintenance. I mean,
yeah, it
okay.
makes sense because they
I didn't even know that was a
'cause they
thing.
lease like office space,
Oh, okay.
and so for that kind of stuff, it's like the tenant kind of does whatever he wants to the space, so he's also responsible for
I
all the
mean,
stuff
yeah,
related to it.
I like that. I mean, as if I was a property owner,
Oh
I
yeah,
would
it's way
like to
better
do
for
that type
sure.
of lease for sure.
Yeah.
Okay.
Go to their balance sheet.
Yeah, commercial real estate, triple net leases features lower rents compared to standard leases. All right, and you would want to do that, right? Right, makes sense. Wait, what did you say?
Go to their balance sheet.
Okay, gotcha.
Oh, first, wait, how much is the company worth? Like 50 billion?
Market cap, yeah, what was that here?
Down,
Market
right
cap
there.
54 billion, yeah.
Look at that.
Enterprise value of
All right.
82. Yeah, so they got a bunch of debt, but yeah, that's good.
Yeah, it makes sense. Go to the balance sheet.
Yeah, well, hey, what's up, GRT? How you doing, brother? It's been a while. Easing my way back into the live streams. Balance sheet, where was that? If I
Down,
just
down, down,
all right, really where I was, really. Huh?
down, down, down,
Show more here on
down.
earnings? No.
No, no,
Statements.
down,
Ah,
down.
yeah, that's what it was. Balance sheet. Okay, annual, right? Yeah, okay.
Yeah, it's good. Okay, so their portfolio just grows every year, which is
Yeah.
awesome. But then what about their How much of that is financed by long-term debt? Let's see.
Then it seemed like they deploy a bunch of cash here at some point, or for some reason. 22.
I mean,
Was this COVID?
relatively.
Maybe they took advantage of COVID, or they had a big pound for. Anyway, what did you want to see?
I mean, yeah, if the rents get frozen, then their dividend has to be covered by. But yeah, go down
Yes,
to their long-term debt.
or maybe also because the price of real estate went down, so they had a chance to buy. Yeah, because look, there's also something here. Like their goodwill, they must have acquired some company that year. That's why their cash went down and their goodwill like went up. Anyway, cash is what you want to know.
No, long-term liabilities.
Oh, here it is. Not Catholic
Oh, this
anymore.
is.
Still Catholic, brother. Just like finance as well. How you doing? You still Catholic? Okay,
This is
so long
oh,
term debt.
this is
Uh,
great.
yeah. I mean,
Yeah, this is fantastic.
why do you say it's great?
Their leverage is like they've financed only about it's like less than half of their assets are financed with debt. It's really good.
Ah, I see. Yeah, like the like debt to assets ratio. Yeah, I see. Yeah, which
Hmm.
means they have a good amount of equity. Yeah, and it keeps growing.
Yeah.
Well, it grows at the same rate. Yeah, I don't know if this is growing really, but yeah, that's good.
Yeah,
It
yeah.
is
I
good.
mean,
It's good.
the health, the leverage is like it's like it's healthy, you know, like because if you do the same thing,
Mm-hmm.
it's like what I was telling you before. If you do the same thing and you look at AG and C,
Oh yeah,
it's like
that's
it's so scary, bro. Because like
okay.
you can't. I mean, you could probably figure it out. It would take like some pretty in-depth analysis, but like you could figure out how much a change in the bond prices would essentially evaporate any positive equity of the company
Hmm.
because they're leveraged. Pardon my language, but to the tits, you know. Like, look at
Yeah.
this, right? So they have around $85 billion, $88 billion
Oh my
dollars.
God. Yes. Yes. Yeah.
Yes,
Yeah.
and then mind you,
And
yeah,
they've
their
been
equity is
lowering
9
their
billion,
equity. Yeah.
and their market cap they traded around book, to be fair, or less than book even.
Hmm. Right. Like
But
they're
they
better. They're
fluctuate.
more value than, or like yeah, they're cheaper for their value
Yeah,
than all. But
yeah.
yeah.
But then But the thing is that with this much leverage, what happens if bond prices change in a way that they're not forecasting? You know what I'm saying? It's like
Yeah. Yeah.
a very small percentage change in the bonds that they hold would
Right.
essentially eviscerate their entire equity.
Right. Well, then again, I mean, it was this kind of goes back to what we were talking earlier. If the mortgages, which they are already set, you would rather own the mortgages than the new bonds. So it's the same as the existing bonds, in which is like if they should go up in price, those mortgages, if
Yeah,
the
yeah, yeah. Right
rates.
now, in this environment, yes,
But in a
for sure.
recession, this is really bad. I assume is what you're saying because
At
all
any
these
moment in
mortgages.
time, for any reason at all that nobody can figure out. You know what I'm saying? Like it's just like,
Yeah. Okay.
yes, forecasting is all great and everything. Thing is that you have no, it's like the cushion aspect is like you can guess whatever you want, but
Yeah.
then anything could happen. And then in the case of like something they're
Hmm.
not expecting,
Yeah.
it's
No,
like such a dangerous thing.
I think it's also like I'd rather like as a whole, if I like don't look at how much return I get or the dividends and stuff, I'd rather own real estate, which is what these people do. Like I own a bunch of assets that are financed by some debt than this, which is just owning debt. Like I'm owning mortgages. So yeah, I mean, like, cause then it's like what you're saying. I don't know if that's what you're saying exactly, but like what I'm thinking of is if there's a recession, if anything hits the fan, it's like I'm holding the debt that many people would probably default on, which is their mortgages.
Yeah.
So
Also, let me because look at their total shareholder equity.
these guys
Hold
or
on.
oh,
Yeah, yeah, these guys.
total shareholder equity. Oh yeah, here it is.
So like their total equity, I mean, it's the 5-year average is pretty much the same,
Mm-hmm.
but their total debt has gone up by a lot.
The
Well, I guess it
total
was higher in
debt
2020.
has gone. Like you mean in the past 3 years, but the shareholder equity has stayed the same,
Yeah, yeah.
which would
Like
mean yeah, their assets has gone
they're
up as
levering
well.
more and more to to produce the same amount of, I don't know.
Ah, yeah, I see. Like the
What's the
debt to
point,
equity
right?
ratio is going up.
Yeah. Like,
Yeah.
what's the point of that? Why are they doing that? Why are they taking on
Mm.
more debt and buying more assets if they're not getting any more unencumbered positive correlation to mortgages, you know? Because
Also, the
if you
fact that
just
you're
stated,
saying that it's all short term, right? Which is
yeah,
why
well,
I'm thinking this
they're
is
right
not
there.
really telling us anything but the fact that they own mortgages. Like this just says that they own more mortgages. Like they're not
Yeah,
taking more debt, really. All they're doing is they're
right,
buying more mortgages. So I mean, then it does make sense that this stays stable and this goes up as much as the assets do because their assets are mortgages, so therefore they are owed
right.
money in the short
But
term, or they owe
but
money.
why are they doing that? Why
Uh,
are they why are they taking more debt to buy more mortgages
But I don't.
if
I feel like you're looking at
anyway?
it the other way. It's not that they're taking more debt to buy more mortgages. That they have more debt because they own more mortgages. So the question is, why are they buying more mortgages? But the debt, it's like it's all short term. Like it's gonna go up
Oh,
if they own more mortgages. They're not going more in debt. You know. You know what I'm saying?
yeah, yeah, but I'm saying they are taking on more debt. Yes,
By buying
it's
the mortgages, they are taking
by
more
buying
debt.
more
Yeah,
assets,
but that's the nature of their business.
right?
But yeah,
But
right.
their net exposure is not changing because that's the equity. The equity is their net exposure, right? If you think about it like that, it's like
Mm,
they have 9 billion in positive exposure because again, like think about it like it's like whatever the
no.
excess is, they're gonna pay off the debt and they're gonna be left with whatever's left, right? So you can achieve the same thing, you can achieve the same net exposure by having 20 billion of mortgages and 10 billion of debt financing those mortgages, right? The same, you get the same net exposure, and their net exposure has not changed. It's actually gone down from when they had less debt. Well, this is why it's a little weird because their liabilities in 2020 was also pretty high relative to the 5-year average. So they did have like had the years of delevering and now they're relevering.
I just don't think it's a matter of levering here. Like I mean, it's levering as much as the type of assets that they buy are debt. So therefore, it's like they are gonna I mean, this going down is just basically the fact that they're not getting as much value for the price they're paying in those mortgages. I assume,
No,
like
their
they're just more
assets,
expensive
no,
mortgages.
their
But
assets are debt, and their debt is just debt.
no, but this is not like this is just a man like part of the fact that they own mortgages. Like it's not
Yeah.
like they have financed themselves through this. This is just
No, no,
because
no.
they owe the money on the mortgages. You know, like it's like it's
Yes,
like if it's
they,
flowing through
but
them by the fact that they own mortgages. That's what I think it looks like. You know what I'm saying? Like
no,
they're
the asset,
buying, but like it's like
yes,
it goes at the
those are
same rate.
those are the mortgages.
Yeah. So
The
by
debt
owning
is
these mortgages, they have to pay this interest, or like they have to pass it through. Therefore, because they have to pass it through, they have to put those interest in their balance sheet as a short-term debt. Like they own these
no,
mortgages. That's what I
no,
think it is.
they no, they buy no. This is if you go to their investor relations page, it's like
Okay.
their repos, like sorry, not repos, their swaps. Like
Okay. There's
yeah, it's
swaps.
not. It's like repurchase agreements or whatever. Like you'll see. I don't really get it to be honest, but
But
it's
what do
not
you what
like
do you want me to go?
they're they don't have like 90 billion of unencumbered mortgages and then they're just stating that that debt is part of their debt on their balance sheet. That's not what it is. The debt,
No, no, that's not what I'm saying.
mortgage debt,
Uh-huh.
considered an asset. Okay, it's not all right. That's not what
That's
you're
not what
saying.
I'm
Okay,
saying. What I'm saying is that this is just
right.
part of managing. Like, if you own mortgages, which is in their assets, those
Mm-hmm.
mortgages are going to pay you an interest, right? And now,
Yeah.
because they are a rate and they got to pass through that interest, they owe that interest, you
And you're
know?
saying that's the total of the interest. That's not the total of the interest, bro.
No,
That's
not the
insane.
total, but like, it's just like, and I'm not saying it's just like the money that they owe that they got to pass through is reflected in the notes
No, they
payable.
don't pay interest. They no. What are you talking about, bro? The mortgages pay them
Yeah, and
interest.
then they got to pass it through. Therefore, they owe that money, no?
What do you mean when you say pass it through? What are you talking about? They don't owe, what are you talking about? They owe money. They don't owe money. They're not buying mortgages. They're buying mortgage-backed securities. It's
Yeah.
a bond.
Yeah, which gives them money, and then that money that they get, they gotta pass it through. Therefore, it's an obligation. Therefore, it's a
Pass it through
liability
what? What are you
to
passing
the
through?
investors. No, to like
Yes, but
whoever.
then That's
Hmm.
not
I
that's
see.
not what notes payable means. That's not what that means at all.
I mean,
That's
notes
like
payable was like, yeah, no, I know what you mean. That what I'm saying is not accurate because that would be like I'm talking about like dividends, right? Basically.
yeah, yeah,
But
yeah.
it's like, but then
That's
again,
not.
I just if it's a dividend that you're forced to pay, that's why I'm like,
Mm-mm.
maybe it is considered a notes payable.
No, no, no. The notes payable is because
Ah,
these are reverse repurchase agreements. So they buy mortgages. Like go to their investor relations. They break it down much better.
yeah, I
You
mean,
can
it
Google it.
can't be that because if we look at O, which is also a rate, they have no notes payable. But yeah, but
It's
they have
not.
dividends
It
payable, which
wouldn't be that.
no,
You know how
but
much money
wait.
that would be?
Oh no, but
You
here it
know, you
is.
know how
Yeah,
much.
dividends payable. Yeah, yeah, no, I see what you mean. This is the part
Yeah.
that I'm talking about. Okay, okay. This is the part
You
that
know
I'm
how much
talking about.
money it would be
Yeah,
if
no,
they
no,
had
something started to not add up. That
7
that
billion?
because it
It
would be
like
equivalent to the value of the mortgages themselves, not to
it'll
not
be
to the
it'll
interest
be like
payments.
it will be a 1,500% dividend every quarter,
Okay, okay,
every
fair,
year, bro.
fair. All right.
Insane.
By the way,
But
hey, 461. Yeah, I know. Yeah, we saw that we were talking about Charlie Kirk earlier. I don't know if that's what you're referring to, but yeah, we should all pray for the U.S. But yeah, and
yeah,
GOT, we don't have the tag on Catholic because as you can see, we're not really discussing anything Catholic. But you know, anybody's welcome here. But what were you saying? My bad, bro. Just wanted to address the people.
oh yeah,
So
go to their investor relations
yeah, here.
and then just click on their most recent 10K or whatever.
Mm, yeah, here. Annual reports.
The filings. Oh, okay.
Oh, not this, I suppose. Yeah,
You
SEC
can
fund.
use that too. It's the same.
Yeah.
It's
Okay,
pretty much the
let's see.
same thing. They're gonna include the balance sheet, I think, there for sure.
I mean, this looks
Unless they
pretty.
don't.
Yeah, unless
I'm
this
pretty
is
sure
like
they do.
something more of like a presentation. Wait, did
It
they
is,
just
but
went
like,
public or what? What is this?
no, I don't know.
Am I looking at the wrong 2023? Yeah, okay.
Yeah, yeah.
Maybe they just have that picture always. Okay.
The team over there, they
Yeah,
know where the
obviously they didn't
executives.
just go live. I don't know what the hell I'm saying. First 15 years. Oh, they just, it's like a, yeah, anniversary, 15 year. Okay, okay.
Mhm.
Terrible micro. What do you just want to see the statements, my bad, right?
Yeah, probably. Oh, yeah, there you
Okay. And now what? You
go.
want to see
Right.
the notes on them or something?
So now look. No, no, but like read. So now this breaks down the
Ah,
composition of
there
the.
it is. Repo agreements, right?
Yeah, yeah. So it's essentially like if you look at
Ah, okay.
yeah, yeah. So they have a bunch of MBS at
Mm-hmm.
fair value. They state the fair value there, right?
Mm-hmm.
And then they buy them under the agreement that they have to sell them. It's like that's what the
No,
aspect
no,
of
right.
debt
The
is, right?
repurchase agreement, right? They just. But wait, if they are the one holding the liability for a repo agreement, that means that they have the obligation to buy those properties back, which means they are the ones selling it. Which means, yeah, they're using it to raise funds short term.
Yeah, they're pretty much
Yeah. Okay.
using this constant thing
Uh-huh.
to create a net positive exposure to MBS, right? That's what they're doing.
Oh, okay.
And so their equity is a good gauge. It's not exactly one to one, but their equity is a good gauge for their net positive exposure to MBS, right? Because everything else is kind of like the line items for everything else is kind of
Well,
small.
well, I mean, I don't know if I mean if but they make money from owning like that. Like even though it's the
They take,
net positive, they make more money from the fact that they're leveraged, right? That they're constantly exposed more
Mhm.
than the cash they
Yeah, but
have.
only
Right? I don't know. Am
only
I
up
thinking
to
right?
the difference. Only up to the difference. Like,
Really? I mean, I'm trying to
yes,
think exactly
because
what they're doing here.
part of their assets, they've already used the interest rates. They've already capitalized their receivables under those agreements. So all the interest rate exposure, like all the interest rate that they get paid for owning these things, is
Yeah.
already been capitalized. So it's already part of that net exposure, right? Because if you look at, I think they have a line item. Yeah, okay, so receivable under reverse repurchase agreements is 11 billion. I think that's like the net interest. You know what I mean? And then at the bottom, it's
Hmm.
obligation to return security borrowed. at fair value. I don't know what that means. This part is like a little bit
Obligation to
confusing to
return
me, but
securities borrowed and the reverse. Yeah, so they are the ones. They have a repurchase agreement and the obligation to return securities borrowed.
that might be the equivalent of the debt payments, right? The net interest on the debt, right? So if 11 billion is the net interest of the mortgages of the MBS, 10 billion is the net interest that they have to pay back along with the money, the money that they've borrowed or whatever total amount. So their equity is like their unencumbered price exposure, not interest like it's like
No,
their price exposure to bonds, not counting any interest effects. You get what I'm saying? Like, see that to me, so this to me, that 11 billion is like interest payments from the mortgage-backed securities that they own. Okay? 10 billion is the total amount of interest payments that they owe to the issuer of the debt, right? So you can see that they have a net positive interest rate effect, right? As in they're buying something that has a higher interest rate payment than what they pay on their debt. And that's pretty much, I'm sure if you will go back and look at the income statement, then you'll see that that's pretty much like their net income is probably around 1 billion, right? Per year,
well, it's
2 billion.
2 billion,
Yeah.
and then there's the interest expense, and the net interest is minus 200. Yeah, I guess like
Yeah. So
yeah, so they're like
lost.
constantly working. I'm still trying to figure out exactly the cycle here because I don't get why they have both repurchase agreements and then reverse repurchase agreements. So it's almost like they they agree to repurchase a property that they are leasing out. So they give the property to get the cash,
They're
and
not
the,
leasing. There's no property involved, by the way.
what do you mean? There's no, well, MBS,
It's
whatever. I mean, as
mortgage.
equities, securities, whatever
Well, it's
asset.
bonds. Yeah, it's all bonds. Yeah, yeah, yeah. It's all bonds.
But that's securities of 49. Okay, agency securities at fair value, and then a repurchase agreement. So they have the agreement. They gotta repurchase this.
No,
But then what is this? Uh-huh.
a repurchase agreement in a liability section is the
Yeah.
opposite. A purchase agreement in the asset section would be that they have to repurchase. This is like
No, how? How would that make sense? If they send the liabilities, it means they have to do that repurchase. They owe fifty
no,
thousand. No.
the liability is that the bond can get repurchased.
Why
From
would that
them.
be a liability? Yeah, that's why I'm like. I think that would be
Yeah,
the
that's
reverse repurchase
so.
agreement. Like no.
By the way, I've been looking at this company for so many years. I don't know. Like I
Okay,
don't get it at
let's
all.
figure out. Let's ask the boy. Like what does it mean? Does it mean for a rate to for a company? I guess for a company to have a repurchase agreements line in there. That is in the balance sheet. Damn, that was quick. Okay. Financial institutions, right? The company sells securities to another party with an agreement to buy them back. Yeah. The higher buyback rate reflects an interest rate, effectively the cost of borrowing cash. Okay, yeah, we know. Okay, so the cash received from the repo is recorded as an asset, right? So then the obligation to repurchase the security is a liability, right? So then, yeah, this is the money they receive from given the property, from selling the properties, right? Exactly. Okay, so they sell the properties for 43 million, and they agree to buy them for 50 million, which means they make 3 million, and the person buying the property has to pay them back. Basically, it's expending 3.6 million to own those properties for that year or whatever. Yeah, exactly. So then that
3 point.
difference would be the profit that they make by those repos. But then this is the part I don't get. If they have a reverse repo, that would mean that then they are doing the same. Because the obligation to return, so then they buy 10 million or 11 million of properties that then they have to return these properties, no? And they are receiving what the fuck? They are these are the properties they're receiving
Why are you saying properties?
because
You
if
don't
it's
even
a
have. What do you?
repurchase agreement, you have to okay properties. Sorry, yeah, like securities, whatever thing, asset. If it's a repurchase agreement, you are giving away an asset that you're gonna repurchase. Now, if they're doing a reverse repurchase agreement now, it's like they are the ones. Okay, let me
Why don't
just
you just
ask
ask?
again. Yeah.
Just ask ChatGPT how their business model works. Like literally, just
Oh, okay. I
you know,
mean, I guess, but let
think
me 1 second. Let me just ask this one now, just to fall in line. And what does seeing a secondary agreements line in their assets? The company is a lender of cash, not a borrower. Yeah, in exchange for property, right? The company gives a cash to a counterparty in exchange for securities, with the counterparty agreeing to repurchase those securities at a slightly higher price. The company has a claim or receivable against the counterparty for repayment of the cash it lent. Okay, so yeah, the other company that has
you know why
agreed.
this is
What?
confusing? You know why this is confusing?
Why?
Because the assets are debt, and the debt can be considered assets.
Yeah, I mean, because it's a
You get what
security, right? They own they
It's
own
a
the debt.
bond security. It's like a debt security,
Yeah,
but it's
yeah,
like
yeah,
it's
exactly.
different enough in that it's like the opposite. It's like they're they're lending money, but
Yeah.
it's like they're borrowing
Uh huh.
because they're because it's debt that they're getting. Like
Yeah. No, no,
it
no.
really
I get it.
really
And the
fucks with
and I think the added complexity is the fact that they're not just settling for the owning of that debt. Is that then once they own that debt, they re-lend it as a repo,
Yeah, man. Oh my God.
and then they also take their own repos. It's
I'm not
like
ready.
they give away the property with an obligation to rebuy it, and then they take on property with the obligation of the other party to rebuy it. So the other party agrees to rebuy the property for this much, and they bought it for this much, or at least that's the value of the property at fair value. And then, right, okay. Oh, okay, but then no, but it's always lower. Okay, yeah,
I think the
yeah, it's always
simplification
lower.
that I made is correct.
What is the simplification? That you just
That
go to equities?
their total
Oh,
equity
equity,
is
yeah.
just their unencumbered exposure to mortgage-backed securities. I think that's like literally it's just a convoluted way, and it gets to
I mean,
that
I
same.
just yeah, I guess the reason why I'm like drilling on because I think you're right, but I just think it's like it doesn't really matter because I feel like part of the reason why they do this back and forth with the repos is who's getting the interest on those mortgages. You know what I'm saying?
Yeah,
Like, so it's like
sure.
sure, their exposure to the like the net exposure is this, but the question is the reason they're doing all this is probably what provides them whatever net interest income they are looking
With
after.
their income, yeah. But it's like the value of the equity can change dramatically depending on the price change of the right?
Yeah.
Because one part of the repo agreement is
Mm.
stagnant. It's unaffected by the change in mortgage-backed security
Right,
price,
right, right, right.
right? Whereas the
Yeah.
other aspect
Yeah. I guess
is
that's
exposed.
why. I guess that's why, like, when it doesn't go well, this is what happens.
They lose money on the interest. Yeah,
Because they just made the wrong agreement, or they were on the wrong side of the repo agreement. So, yeah, I
yeah.
guess. Wait, but how do these people
Or maybe
consistently
not. Or
manage
maybe
it?
not. That's the thing. Like it could just be that like they might in a year decide that they'll lose money on the interest trade because they know that they'll gain money on the appreciation of the mortgage of the MBS. You know what I'm saying?
Oh,
And that's because like look like look at
like this?
they had a
Ah, this is what you
positive
mean?
other gain. Yes, unrealized gain on
Uh,
investment securities. Yes, all right. So
well, but these
they
are
trade.
unrealized. But yeah,
Yeah,
okay. But
because
yeah, but yeah,
again,
but yeah. Okay.
yeah, it's like they trade essentially, and they say, okay, well, we'll lose money on the interest trade because whatever the
Okay.
repo has a higher applied interest rate than the interest rate we get from the mortgages,
Uh-huh.
but we think that mortgages are going to go up, and
Hmm.
so the unrealized gain will cover that, and we'll be positive for the year, and we can pay our dividends with cash or debt or whatever it might be.
Hmm.
until we get a year in which the interest rate is positive and we actually make money that's realized. You know what I'm saying? Like,
Hmm. I mean,
or
to
maybe they
me,
do realize. Maybe they
yeah.
realize it in the next year. Like if it's unrealized in 23,
Uh-huh.
maybe at the start of 24 it's realized, and then they have enough money to pay dividends for that year. You know what I'm saying? Like,
Yeah, I mean, it is weird that this is part of their income, unrealized gains and losses. What the hell? I mean, I don't
yeah.
know. I mean,
Well,
not
like,
weird as in them individually, but the
well,
fact that this is a like this type of company would record unrealized gain losses as part of their income.
they trade. I mean, yeah,
Right, right.
but they,
That's gotta be it,
yeah,
right? The fact that they trade.
that's their whole thing. And I think like,
Hmm.
yeah, it's the weirdest. It's the weirdest rate. Other rates are much more straightforward than this one.
Also, the fact that this is the same, right? What is their like? If I go, how did I? What did you show me how to go back to the thing without, right? What was
Yeah,
it?
to the right of the statements thing. No, down,
Oh, like
right.
this, right? Yeah, yeah, yeah.
Yeah.
Right? Yeah, okay. Like
Yep.
if I just want I want to see their dividends, like their dividend history. Like are they still with all this back and forth able to maintain a dividend or no?
Go up, up, up. No, 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 no.
Oh, my bad. Oh, here it is,
Right there.
dividends.
Yep.
Okay, so let me see. No, okay. So this is what happens then, I guess, that they cannot guarantee a dividend.
No, absolutely not.
Okay, fair.
And it's like if you look back at their like if you went to ROIC and went to the 10-year, you would see that like the company is shrinking because they do sustain losses. It's like yeah, like what they're doing really open
Yeah.
possible. Like you'd have to be a fucking savant, and even then, it's like so difficult to do what they're doing.
What are we looking at? Just the dividends over time? Yeah, yeah, yeah. Okay,
Yeah,
yeah,
but you
that's
can
like a
look at their like
crazy dip. Uh-huh.
yeah, or you can look at their total equity over time.
To
Oh,
win
their total
in
equity is pretty stagnant over time.
this.
Yeah, honestly, that's impressive. But like also it's not because why haven't they been growing their equity, you know?
Again, because I just don't think I think that there's something about that it's like the business they're in is not into having more equity, but just like being able to move back and
Yeah, because
forth a
again,
higher
they
amount of
give
assets.
away all their excess cash, right? But it's like
Yeah.
I don't know, man. It's every year they get it feels like they get more and more leveraged to the point where it's like
Yeah.
I don't maybe I'm wrong. I don't know, maybe I'm wrong, but it's like I don't know, you're essentially becoming bigger and bigger to eke
Mhm.
out the same amount or less of total income. It's like I don't know how it works out in the long term. It's like what do you become a business that you own 400 billion in assets to be able to pay a lower dividend than you did 5 years ago? Like it's I don't understand how it comes to a point where it's sustainable, you know?
I mean, are there assets? Let me see. Are there assets going up every year type of thing? No,
For
but I
sure
mean,
they are, yeah.
oh no, this is not it. What the
This
hell?
is the sales
Yeah.
down right here. Yep.
Where are we? Yeah, I see.
Like look at that.
I
It's
mean,
like
but then look, it's
actually,
like
yeah, it's kind of like they just do,
they just manage, bro. Like they just
yeah,
do
they just
what
manage.
they just sell them when they need to, and then. But then it's like, and then I guess suppose that debt is moving at the same pace, right?
Same, right? Yeah,
Yeah,
because again,
they
their
just
equity is
keep
the
it in
same.
par. Yeah, okay.
Mhm.
Yeah, yeah, yeah. So then it's just, but then I don't know what the fuck they do. Like, what is the point? Like, they just good MBS arbitrage or something?
Yeah,
Is that what?
but bad MBS arbitrage because their dividend has been decreasing over time.
Well,
It's like,
again, I mean, I guess I was thinking of looking at like does ROIC show me like dividend yield over time? Because maybe it's like like in terms of how do you
the
say?
yield itself.
Yeah, exactly. Like because the stock price has gone down, so it's like if they just maintain a dividend yield, dividend payout ratio, that's not it. No. Although
Mm,
this is so this I don't even know what the fuck to do with that, but I don't think
yeah,
that's an appropriate metric here.
kind of
Liquid,
is.
what would it be? Well, I mean, no. Okay. Dividend per share. It's a percentage of, I guess, what I want.
Like, look, if you just cut through everything and said, I'm gonna model this company on a dividend discount model, right?
Mm-hmm.
Then right there is what would tell you that the company is worth nothing.
Wait, what? Say it again?
Their dividends per share
Yeah.
have been constantly decreasing over the course of their entire history.
Oh, yeah, I guess I didn't even notice that. They are constantly. That is the constant here.
Yeah. And so if you model this thing, if you use a present value model, this
Uh-huh.
company's worth zero.
Huh. Yeah, because then it's like, right, I'm thinking if I own it, right, I'm like attracted by a dividend yield. But then it's
Yeah.
like the dividend is going down and the stock price is going down. So yeah, I'm able to buy more stock that is going to depreciate later on. And then on top of that, I'm going to get a lower dividend next year.
Yeah. If you boil everything down to just
Damn, that's kind of a trick.
exactly, yeah, exactly. If you boil you boil everything down to
These
the
people are
present
really getting
value
paid to just
of
steal
all the promised
shareholder
cash flow. Yes,
wealth.
exactly. It's like
No
if you
way.
really just boil it down to the present value of their cash flows, you realize pretty quickly that you're cooked. It's like you're never gonna make money.
These people are just funneling the money out of the stock market.
Yeah, it's like money's just leaving. Like they just I don't understand where it's going.
Yeah, look,
Like I really don't.
everything. Yeah, but it's like how I don't know. I feel like I don't know if it's one of those like it's obvious because it's true, or we're missing something. It's just funny. Um,
A beautiful trap, you know? I don't know.
yeah, it is kind of elegant, whatever the case. Cash flow per share also going down.
Because again, the thing to
Everything,
me
yeah,
that's
just
weird
everything
is
is just going
like
down.
the
You
thing
look at
that's
the
weird to
book
me
value too. It's weird,
is
bro.
like
I don't know.
why is there they're always maintaining their equity. So it's
Ah,
like
right.
I don't understand.
How are the assets growing? Their equity stays the same. Somehow ending up with lower dividends every time. And
And
running
lower
free
price,
cash
lower
flow.
stock price. It doesn't make any sense. It means, I mean, maybe it could mean
I mean,
that
one
for the
second.
first time in its history, it's trading at below book value. It has to mean that, right? Essentially,
I
that
mean,
like
but they've been they're trading at below book value for a while, no? I mean,
no,
book
but
value has been
it
negative.
can't be it can't be because no, they're sorry, not their book value, their equity value. If the price of the stock at some point had to be way higher, like the market cap had to be way higher than the equity at some point for this to make any sense. Because now it's at less
Hmm.
than equity value, right? And it's like equity hasn't changed, but the price has gone down. So it must mean that at some point the market cap was much higher than their equity value because their equity value has always been around 10 billion. Let's say it's 10 billion, whatever, historically speaking.
Mhm.
When the stock was trading at whatever, like $30, it means that they traded at a three times premium to their equity value,
Yeah, but it's
right?
like also that equity kind of like it wasn't always 10. It's like it was
No,
like
but that year,
1.1.
yeah, but like I'm talking about from the 10 billion onwards, it's
Yeah.
always been around, around that value right
Mm-hmm.
there.
Right.
But at some point, the stock was triple the price that it is now, which means that at that point in time, it wasn't trading at equity value. It was trading at three times that.
Okay,
So
but
yeah, I mean,
why
I
do
know
you arrive at that? I don't get how you connect the fact like why does it have to be that way? Why you say it has to be traded at some point at a much higher multiple of equity?
because if the price of the stock was at 30, it means that the market capitalization was at three times what it is now. If shares stay the same, which they have, if you see it's like around 4 to 500. I guess that is a pretty big range. But like look, like go to like a chart of
Yeah,
agency,
no, I'm trying to
right?
get to that.
Like the Google chart, and then hit the 10-year or the max share. Right? So like when the thing was at 30, go to like its peak,
Yeah,
right?
yeah.
In 2012. Oh, we don't have that data, right?
What do we want to see? Oh, like yeah, I think we
Match
do.
it up to 20. What year is
Yeah,
this?
2010. We have from
2017.
2010 to 20
Okay, so
2024.
look at 20 look at 2012. in 2012,
2012 is
the equity
this.
was 9 billion or
Well,
10, 11
10.9,
billion,
yeah.
11 billion, right? And then go to
Yeah.
the same year, 2012 on the stock market.
Yeah.
Right. So the company was at $30, which means that if the share amount didn't change, that means that the market cap then was around 30 billion, which means that it was three times the equity.
Yeah, shares outstanding. I mean, they have kind of gone up a lot.
Not
I
not a
mean, triple, bro.
yeah,
They pretty much
yeah,
triple, bro.
yeah, fair enough.
So it is funneling money, bro, out of the stock market. They're just raising more fucking money from the stock market
Yeah, it
by
is.
issuing shares, which dilutes it, which, yeah, and
But
then,
funneling money,
right?
they're just paying out, I guess, right? Or no? I don't know.
I mean, if they're issuing shares, then who the fuck are they paying? I don't get it.
No, it's like they're leaking, it's like part of their distributions to shareholders
Hmm.
are also leaking value out of the company. I think that's what's happening.
Sure, but I mean, they have to be issuing shares. I don't know exactly what you
Yes,
mean, but
yes, they are, they are. But
yeah, I
I'm
don't know
saying like
exactly if that's part because they pay a stock dividend or something like that. Like they
that's
just
part
pay.
of that's part of the leakage factor is like in the years where their operations didn't cover the dividend that they were promising, they probably issued shares to get the money to pay the amount that they owed, you know?
Yeah, I guess. I mean, one way or another.
Because they can't issue debt because all of their debt is used to buy assets to make the
Yeah.
yield or whatever, right?
Yeah, I mean,
So in
they
the
have
years where they
some
need
long
more
term debt,
money,
but it's like nothing, right?
they
No, I
probably
mean,
just
they even
issued more.
reduced
They
it. Look, if you
probably
look
just,
at the long term debt, it's like at some point they did have more debt and they just paid it off. Maybe they realized there's no point.
what is this?
Long term debt. Can you see it? By the way, just.
I can see, I can see. No, no, I can see, I can see. I'm just like, yeah, yeah.
I don't. it's so confusing. Yeah.
This company's a
I
dud,
get it
bro.
now. I remember you years ago telling me about like I was like, oh, Jinsu looks great. You're like, yeah, but they're fucking confusing. And I was like, how can confusing can they be? It's just a rate. It's like they're not just a rate.
Not at all, yeah. They're just a convoluted thing.
I mean, let's see. I mean, at this point, let's see. Can you act as an expert equity research
You're making
analyst?
ChatGPT cosplay.
I mean,
Crazy.
bang
What world we
and
live in.
say, ooh, no, okay, and analyze the company agency specific
Did we check if the stream
specific.
can hear me and if the stream can hear you? I mean, the
Oh my
stream can
god,
definitely
we
hear you.
didn't, but they can. Okay, thank you. But yeah, I mean, yeah, that we should be doing that every fucking
Can the
time.
stream see? Can they see the screen?
Yeah, yeah, they can see screen.
All right, good, good, good.
I mean, you can check it yourself. Open the stream, but yeah, I mean, according to OBS, everything is in order. But you should maybe check from your end.
Yeah, let's take a look.
Thank you. Specifically, can you go in more detail about the
Hold on,
business
I have
model?
to mute you.
Yeah, okay, okay.
No, it works. Okay,
Okay, good.
they can hear me.
Okay, it's gonna take a little bit, but yeah. Okay, maybe this guy will tell us something interesting. But okay, so agency maybe it's not something I wanna be in. Let me get it out. Unless this guy just gives me some crazy insight. Now, oh, maybe. We'll look into it, but shake some eh, some where are we? So many windows. This, yeah. Okay. Here's the how agency works view. Damn, ChatGPT 5 is way faster. Like institutional client. Tight model first, then drivers and risk. Oh, client? Wait, I don't get. Okay, whatever. Where's agency? What agency is? Internally managed mortgage rate that invests almost entirely in agency residential MBS. Securities guaranteed by Fannie Mae, Freddie Mac, or Ginnie Mae.
Got an ad.
Oh, you're gonna damn.
My God.
What's the whole thing so I can get my 3/4 of a cent? The
Yeah.
agency guarantee makes credit losses de minimis. Agency's game is interest rate, prepayment, and funding basis management, not credit picking. Damn, it's already getting confusing. Car business model, how they make money. Own agency MBS. Focus is predominantly fixed rate pass-throughs. Okay. The portfolio plus TBA. Okay, what is TBA? Exposure was 82 billion. Okay. Finance with short-term repo plus TBA. What the hell is TBA, bro?
Oh, I know
TBA.
this.
All right.
Oh yeah, I don't know this.
More. Oh, trade to be an. Wait.
No, no, no,
Oh, it is to be announced.
no,
It says here, what is
nah, bro.
TBA? Mortgage-backed securities. Refer to trades of mortgage-backed securities made without initially detailing the exact securities involved. TBA market includes pass-through securities. Counterpart the default risk exists in TBA. TBA serves as a contract to purchase or sell an MBS on a specific date. Oh, so it's like a futures contract on a mortgage, on an MBS. Does not include information regarding the pool number of pools. Oh, so it's like they commit to buying an MBS. Okay, and then they
Yeah, it's
trade
just
those contracts.
they called swaps, bro.
Okay. So they have a TB exposure, like they have a they have a futures exposure to an MBS. They borrow against MBSs and repurchase agreements. Okay, so they own the MBS and they borrow against it. I also use TBA dollar rolls, which function like finance for there it is, forwards. Okay. The result is material leverage on low risk assets. Okay. Earn the net interest spread. Primary earnings engine is asset yield on MBS minus funding cost. Right, the funding cost is what they gotta pay on the money that they use to buy minus hedging cost. Agencies are supposed to net spread and dollar roll income. Golly, it's confusing. Hedge the rate risk, not the basis. They use interest rate swaps, swaptions, and treasury futures to neutralize duration convexity. So book value isn't whipsawed by rate moves. Okay, well this is just for hedging it. Okay. Hedging logically targets rate exposure, MBS, treasury basis risk. Okay. Distribute as a rate. As a rate, agency must distribute 90% of taxable income. It's known for monthly dividend funded by net spread dollar roll income. So they do like. I'm still trying to get what the fuck it is that they are doing. Like, they buy this TBA, like these forward contracts on MBS with the yeah, it seems like an arbitrage. They just expect to price it better than the forward contract, and then they profit from doing that. Realized gains. I guess that's where the unrealized gains comes. The fact that they own those forward contracts. A simple earning stack mechanics. Asset side. Buy a 30-year agency MBS at par yielding, say 5-6%. Okay. Finance 85% 90 of that purchase through a repo rolling. At short-term rates. Wait, so they own the TBA, then they make a repo agreement on it to then buy the MBS later on. And then hedges pay fixed, receive floating swaps. I said
Give
they
it up,
pay.
bro.
Huh?
Just give it up, man.
Yeah, I could give it up, but it does sound interesting. Like, I've never seen some shit like this. Like, I mean, I'm definitely not gonna invest in it because it seems too complex. But it's like I've never heard of some shit like this. Like whoever came up with this business.
Not even that it's I mean, it is complex for sure, but like, it's also like what we saw is all you need to know. It's like
No, I get it. I
you're
get it.
not
I'm
even
not
gonna make money.
considering investing. Just now, I'm just out of curiosity mostly. Net spread, MBS
Yeah, but
yield.
we should move on.
Okay,
We should
okay,
move
okay,
on.
okay, okay. Yeah, I'll read this at some other point. That's true too. Okay.
I mean, you're not going to, but
I might, bro. I might.
I respect that you said that you will. You know.
I feel like you don't respect it. That's the thing. I feel like you
Yeah,
just straight up
not that
attacking
much,
it.
not that much. I see it in myself too. You know.
Oh, I see. You recognize it. You can relate to
Feels
my
good in that
statement.
moment to say something like that. You know. You're like, yeah, I'll get back.
I'll
I'll
get
get.
back to this.
I'll really get in the weeds on this in my free time. You know. Bro. Shit. All right. Should we do a screener or no?
Yeah. Okay. Let's do this. I guess the usual way. But I mean, then again, okay. Yeah, I was gonna look into this, but then yeah, I don't know what to do to look into that.
Oh, for O?
For all, yeah, but yeah, let's
Oh,
start
for
with the
O, it's
screen
gonna be
and
way
let's
more
see.
straightforward.
Okay, let's see.
Because if you
I
for
gotta remove
O,
the tabs. Okay, what?
yeah. No, no, nothing. The screener for rates has to be like, hmm,
Wait, are we doing
what's
just
important?
rates? Maybe? Oh, they're all rates. No, there
They're all
is real
rates,
estate management. Yeah, fuck it.
yeah,
Let's
that's
just put the
true.
whole thing. Yeah.
Yeah.
Market
But
cap.
now we need to figure out what we care about because it's not the traditional stuff. What are you doing there? Taking liberties or what?
I don't know. I mean, I'm trying to think of. Wait, greater than 1 million is what we
No,
want.
we don't care. I mean, yeah, we don't really care.
Okay. Well, now it's there.
All right. Wait, what did you do? Go down. You did something bad. No, no. This is what'd you do? You did something like
1 million. Wait, oh, what did I do? I just
the
put
less.
the industry. I mean, we're losing like 300 companies that they have a market cap of less than 1 million.
We're losing no, like 150. How many total is it?
Yeah,
400.
150. Okay. How is there even that many that are in the public markets
Are
worth than
we?
less than 1 million? You want me to take it out? I'll
No,
take it
but
out.
yeah, take it out, bro. Something
Okay,
is
I'm just
wrong.
gonna
Or
put
like
it. Look,
change the
there it
top
is.
value. You
Yeah.
know, but I'm saying like change the like do a million to like a billion or like 100 billion or whatever.
What?
Like just max it out.
Oh,
Wow,
no,
there's
there.
really
Yeah.
150 companies sub
Like,
1
look,
million.
yeah, we can just do it the other way around.
It's impossible.
27. Wait, how's
Yeah, you
that?
see? What the fuck?
Now I'm confused. How the fuck?
Do 1.5. Do 1.5.
Oh, okay.
What the fuck? Yeah, nah, turn the shit off, bro. Fuck is going on
I'm
here?
so confused though. Like, how did that happen? If I
You,
put more than 1 million, it's
we lose 150.
but if I put less, it's not.
Where
What? Where are the ones in between?
there's only 20 stuff. Yeah, it might be that
Yeah.
like they don't even have a market cap, like because there
Ah.
are ones that it says like there's like a dash.
Ah. Still though, why wouldn't they put
So
them anyway? Yeah, just the way it's structured.
just don't touch
Yeah,
it.
yeah,
Yeah.
okay. I'm gonna have it there just to see the market cap, but yeah, I'm not gonna touch it.
All right. We need to figure out what we care about.
I mean dividends, right?
We care about dividend growth.
Well, we want to see
Yeah.
the dividend yield.
No, we don't care about that
Why wouldn't we care about the dividend yield?
because the relative yield is it doesn't matter. Anyway, I guess we do care about it and that we don't want too
Okay,
high of a
okay,
yield
okay. I mean, I guess we're not gonna.
for our
I'm
cash.
gonna have it just to see. I guess we're not gonna use it.
Yeah,
Okay. Fair.
yeah.
And now we do care about dividend growth rate.
All that stuff, yeah, all this stuff matters.
I
All four
mean,
of them.
yeah, increasing this one too. Yeah.
Yeah. All of
Okay.
it matters.
And now three
And we just
year.
want them to be increasing.
Oh, okay. More than zero for all of
Great.
them. Yeah. Okay. And then
That's
increase.
less than zero, bro.
Oh, I did the other way around. Okay. It will be like, fuck it. I'm not gonna do the values thing.
You I think, yeah, I think it's fine.
Yeah, I mean, I don't
Is
know. Whatever.
get rid of the 0 to 5, I think, just to make it a little bit more stringent.
I mean,
And then for that one, like all four for the other one on the top. On the top? No, no,
this
right
is I don't know
there. Yeah.
dividend yield.
Oh,
Yeah.
okay. Sorry.
This is what. Yeah.
Yeah.
3 year, 5 year, 10 year. Okay,
Already we're down to 12 matches. Let's look at them.
that's pretty nice. Yeah, so we're not doing anything else. I guess
No,
what? No,
because I
yeah.
mean,
It is only 12. Yeah. I mean, I guess I was gonna add more columns just to be able to look at them through here. I guess we can do that
we
now here. Yeah.
can wait, but see, why is O not here?
Hmm. Let's see. Maybe because they downground that doing that much. And it's like because it seems like 5% is aggressive. I mean it's not super aggressive, but it's like a lot.
Look on the right,
Where?
the closed head,
Oh yeah. Thank you.
and then go to their dividends. Nah, but surely they've been. No, there's no way, bro.
I guess we're gonna check on ROIC too. But yeah, 3%, 2%, 4%.
Okay. Okay, so I guess we just need greater than 0.
Yeah, we would also not have anyway. Oh, like I mean, this looks like why the hell would we not want to invest in something like this? Or not? I mean, like wouldn't this be more interesting than all? But yeah, okay, let's do it. So that includes all modify criteria. So then maybe what we can do is this. No, okay. So until I include all of them, it's not gonna. Okay, okay. 27. We just look at those.
No, we can do other
Increasing.
stuff.
Damn,
We can
this.
do other stuff,
Yeah, like what would it be? Let's see. No, definitely not that. What the hell?
like relative financial health and stuff like that. But what's important, I think the book
Uh,
value is, but
we don't care about this part, right? Revenue estimate. Because you would like that could be maybe confusing with some companies
yeah, no,
in
we
this
want
sector, right?
I think we just want to
Valuation.
somehow filter for balance sheet health.
Okay, so then financial strength things. Yeah, let's see.
Yeah.
Debt to equity type of thing. Most recent
Yeah.
quarter. Why the hell would that? Okay. Return on asset, return on invested capital, current ratio, cash flow per share. Excuse me. All right, let's see just if we do this. What we do no debt. Yeah, they're none. Fair enough. Um, we want like that. That's still okay. How about less than one? Oh, how about that? But wouldn't we want them to be leveraged? Wait, what do we do? There's two companies with
We
that
do want them to be
plus.
leveraged somewhat, but not
But then, but
insanely,
if we do this, there's no change with it, which is fine too. But yeah, we could just add more. But it's like I don't know what else. Cash flow, like having positive cash flow.
You know what they say about positive cash flow?
What do they say about positive cash flow? I mean, they gotta
I
have
don't know.
positive cash flow if they're
I'm
paying a
asking you.
dividend. So I guess I mean we'll add it because it gets rid of two. But I mean, it's in trend 12 months. But yeah, I mean, why
We
not?
don't want, you know what we want? You
Oh,
know what
so
we
we don't
want?
know what cash flow it is, right? Okay,
I don't
whatever.
even
Let's
know what
do.
the hell we're looking for
Yeah,
in terms of financial health. It's tough to say. Like, we want, what do we want? Trying to think.
return on assets. I mean, let's check O. O will be a reference for the industry, right? So, so if we go to their statements, wait, can I check their ratios? Something like that? Cash flow margin, cash flow per share, cash per share. Okay, so they do have profit margins and stuff. Much lower than their competitors, it seems. This is what we did look. Oh, I guess dividend coverage ratio. Let's see. Can we do something like that? What happens there? Dividend frequency? Huh.
Mm-mm.
We don't care. Okay.
No,
Uh,
frequency is just
I know,
how
but
often
I
they
didn't know if we
pay.
care about the coverage ratio. Okay. So we would want that to be high
High.
because we want to be able to pay it.
Yes.
Income available to common stockholders over the gross dividends available. Oh, okay, so having enough income to cover it for the trailing 12 months.
Yeah, but it's always gonna have, like, it
Yeah.
will always have it.
I mean, it's also
I
like
mean, how you would hope
if
so.
this is a percentage, this means that this is less than one for all of them. Mhm. So then why the hell would you put it like this? The fuck? Yeah, this. Wait, no, no, no. But most of them are higher. So what the fuck is this? Coverage ratio? Coverage ratio. Okay, here. Income available to stock excluding certain earnings for the most recent 20 months to gross dividend paid. Yeah, okay, what the hell is the same? Expressed as a percent. Oh, okay. So, but then, why? Why would this be the? Okay, so this is more than 5%. Is that what it means? Okay, so. Oh, okay, it is in percentage. Okay. So more than 30%. Okay. And payout ratio, which is what? The percentage of the primary basic earnings per share. Well, but it is always supposed to be high, right? Wait, what the fuck is this? 300%? What? Oh, wait, this is the gross dividend available. This is the opposite of this. The inverse, whatever. Income available to come. Yeah. Wait, so then how is this 30%? Well, yeah, it's three times as much. Huh? Right, income is 30% of the dividends, so they're paying, right, so they're paying three times as much. Okay. In dividends that they make in income. Yeah, I don't think this is relevant actually for this. Because it's like that's the whole thing. I'm confused about how like income works for these companies, but let's say.
Well, they just have rent. They have rental income.
Yeah, yeah, but so what is their net income here? Like operating. I mean, I guess so it is important to have good income, right? But then why are they paying more dividends? Okay, let me see this guy's here. What the fuck? Realty Income Corp. Dividend payout ratio. Yeah, so they're always way higher than their income. So
Who?
like discount, like oh, as an example, dividend payout ratio is consistently higher than the income. So I'm trying to understand how the hell is it because of the cash flow thing? It's gotta be the cash flow thing. Like their income doesn't really. Alright, that's it. Hmm, where would I check this? I go to their statements again. And I check net income. 59 million. What would it be? Like EPS, right? Basic EPS, 16.1 cents or whatever. And then dividends. Yeah, exactly. They pay more dividends than their earnings. So how the hell does that work? What is their cash flow per share? It's gotta be that, right?
Wait. Um. Go back up real quick.
Yeah, there we go. So it's funded by the cash flow, the dividend. Which, yeah, the income, that's why I'm like, the income might not tell us much because there's a lot of probably things that are
Yeah.
not cash related.
There's depreciation. from all the assets that they
Oh,
own.
that's the main thing. All right, if I go back to cash flow, I can check what's the main add up. Net income
Yeah,
is 115. Cash flow
depreciation is
variation.
the same amount right there,
Where?
100. Right there, right next to income. No, go back
Oh,
up.
this. Oh, ah, I see.
The
Right.
second, the second
Yeah,
line
yeah.
item is huge. Yeah, it's massive.
All
Look
right.
at
Well, it's
it.
the
Look at
same
it in the.
size. Okay. Well.
No. Look at it in the
Oh,
most
I'm looking
recent
at the
year.
wrong way. Yeah, yeah. Okay, okay. Fair enough.
Yeah, it's massive, brother.
It is massive. Yeah.
Because they
Hmm.
depreciate the value of their real estate, but it's like I think it's just to save taxes, bro. Because what real estate
Hmm.
doesn't depreciate, but they do depreciate it
I
because they
mean,
have like they can, you know?
what do you mean doesn't depreciate? It has to. Everything depreciates.
Not real estate.
What do you mean doesn't depreciate? It does. Just because it appreciates in the value of it, like on a cost basis, everything depreciates.
Uh-huh.
Like, okay, like if you pay 20,000 for it, now you're depreciating on those 20,000, even if the value of the property is going up, right? But yeah, like I get what you're saying. I don't know why the fuck
Sure.
I'm being a nerd about it. Yeah, like yeah, it
Yeah.
does. Yeah, I get what you're saying. Yeah. In the
The
market is going
depreciation
up.
aspect.
Yeah.
The net, the net is an appreciation effect though, but they do
Right.
depreciate it and they don't. Hmm. Yeah, it wouldn't matter how they. Yeah, their assets, their cumulative depreciation would increase, but their assets would also increase because, yeah, if they're measuring it at fair value, then yeah.
Yeah, yeah, but yeah. So I guess my point on all of this is that we don't care about the income statement as much because we just this is like
Basically, these guys are scamming the U.S. government
oh
and not paying taxes. That's what I'm
oh
getting from this.
because of the depreciation then.
Because of like, yeah, because they're depreciating everything. But then like years later, they probably, if they sell an asset, they're probably like,
But they're gonna have to pay
oh,
taxes on that. I mean, it's like it really
yeah,
doesn't.
yeah, they will.
Yeah, the
They
cost
will.
base is gonna go down, so they're gonna have to pay. So,
But they will never sell their assets.
but then I
Hold
mean
on, let me
that
take a
it
picture real
does
quick.
get to zero at some point. Then that's it. That's it. That's the confusing part. Would it eventually get to zero? Then? Yeah, it has to, right? It depreciates until it gets to zero. So then they own a real estate that's worth zero on a cost basis. Yeah, I mean, I don't see. I guess that's why you get a tax advantage on depreciation because it's like you're gonna have to pay it when you sell it because your cost base is going down. Right? So yeah, I don't know. But yeah, if I go to, what the hell? Where is this coming from? Cash from financing. But then what is this in between that I got caught on? Net changes in cash. Why is this
I'm back.
so different from the free cash flow? It's not the same. Also, how do they have no capital expenditures? What is this?
That's what I was asking before. If they're, I don't think investment in real estate is considered capex, bro.
Oh, it's like an investment expense. The change will be
Yeah,
cash from investing, dividends paid. Well,
yeah.
that's just not cash from debt, repayment of debt. But it's repos again. I don't know. Well, we purchase of equity, I guess.
What? No. Not for, what are you talking about?
I'm trying to figure out where would that be the equivalent capital expenditures of buying properties when they buy.
Oh, um, it
Okay,
would
this is a bit
be
confusing there. That's it.
cash from investing. Uh,
Yeah, I want to see it here for a second. Let's see. So it would be here somewhere, right? In the cash flow.
yeah, it should be. If they bought property, I mean,
Yeah,
I
here
don't
it
know.
is. Okay. Capital expenditures. Just
Yeah.
I guess the one that shows in ROIC is like a different capital expenditure or something.
Oh, wait, so then it is. Yeah, it is
Yeah,
there.
okay.
It has to be.
Yeah.
That's a
Okay.
lot. It's like more than their cash from operations.
Ah. Yeah, actually, damn.
So then how are they
We're
paying the
going to the
dividend?
left now. Okay. So how are they financing the? Because well, cash for investing is there, and then total cash from financing. So they are receiving cash from issuing debt. Yeah. Damn. Yeah. Okay. And issuing stock too. Yeah. Okay. Fair. Cash dividends that they pay. Yeah. Okay. Yeah. Net change in cash is this. So then, yeah. Okay. So then, what the fuck is the free cash flow? Why is it high? According to ROIC, I guess. How is this calculated again? Ugh. Like, is this before financing one? It would be, right? I guess that's the whole thing. Free cash flow is before investment cash flow.
Yeah, yeah. Free cash flow is just their operational cash flow minus their capex. That's the free cash flow to the firm. Free cash flow to
Oh,
equity is then you take out interest expenses, like
okay,
their debt servicing essentially.
okay,
But usually when people talk about free cash flow, they're talking about free cash flow to the firm.
right. But then it's higher. So this is all
Well,
before even free cash flow to the firm is before capital expenditures.
isn't it? No, no, no. Free cash flow to the firm is after capex.
So then I think there's an error here because I think they're saying capital expenditure is zero, but it isn't, and that's what's making their free cash flow higher in ROIC. I think that's the issue here. But then if I go here, I feel like we're getting caught up on this thing again. On like one little thing, like almost an hour. But yeah, yeah. Okay. Well, I will. Okay. Let me check the free cash flow. That's what I want to see.
I think
Where is free cash flow? Cash flow per share. Well, but what is just cash flow, bro? There's no way to just check free cash flow on Schwab.
no.
Oh,
I think over time they will eventually start breaking it out.
well, that's annoying. I don't even know. Okay, what if the Morningstar report tells us? Is this O or agency? Yeah. Oh. Hmm. Free cash flow to the firm.
Yeah,
Okay, that makes more sense. Okay, it's negative. So,
yeah.
okay. Jeez.
That's bad. That's what I'm saying. But now,
I mean, they just became positive now, which I guess, I mean, and these people are projecting it will go up. So I guess maybe they just bought a bunch of properties or something. Net income was this, is net income free cash flow. I guess we could search to see in the document where they talk about it. But
no, hold on, hold on a
mhm.
second, bro.
Also they had zero earnings in the past 2 years. Well, but then again, that's probably because of the whole accounting thing that they do.
In a second, bro.
Yeah.
Uno momento.
Let me zoom in here, sorry. Yeah, I mean, Morningstar is, yeah, forecasting an expansion in margins, an expansion in free cash flow by a lot, actually. So there's something here, which is the 3 year average is a minus 120% free cash flow margin. And they're expecting it to get like around 40 to 50 to 60%. So, so there has to be some type of long-term strategy that went down, and that's why the free cash flow went down a lot. So it's gotta be that they're just buying a lot of properties or something. And that's why it's an interesting investment now. Hmm. Damn, they really break it down here at the Morningstar reports, huh?
Oh yeah.
That's nice.
Yeah, so it looks like for the most recent year they just issued debt and that's how they're
Yeah,
ending
yeah.
up with more cash at the end of the year.
Right. Yeah. But yeah, I guess
Uh
my question was why is that a good thing? But it's because they're probably buying.
well no, it doesn't
We view
no.
Realty Income's balance sheet as sound as the company operates with a reasonable level of leverage for the industry. We project 2025 net debt to EBITDA to be roughly 5.4 times, which is within the company's long-term target. As we believe this metric will continue to improve as the company uses free cash flow to acquire more properties. The company's capital investment decisions are fair. Regency growing predominantly through acquisitions rather than
Yeah, I
internal
mean
growth.
that's like that's essentially what's happening. So actually,
Yeah.
yeah, we're looking at it through the wrong lens. We're looking at it through the lens of how are they affording their dividend if they're not generating cash,
Hmm.
but we're not looking at it from the lens of they're using all the cash that they're generating to
Yeah.
just buy more property.
Yeah,
Yeah.
and more. They're using the cash they have and debt to buy a bunch of
Yeah.
properties that then eventually will pay off. Yeah, like they're right at this at a cycle point in which they're just spending a lot to buy properties.
Hmm.
But I don't get, is
Okay.
that a good thing to do in this market? Like for them to be buying? I mean, what do I know the real estate market? But
Well, I was gonna mention that like rates are high. Why would they be buying? But then like you'd have to trust that they know more than us.
right, fair enough, fair
They
enough.
probably have a little bit more experience than us to to figure it out. You know what I mean?
Yeah.
Okay. So I think as part of the screener, let me go back to your
Oh yeah,
screen.
yeah. I forgot all that. Oh,
We
that's
should
good.
add, we should look at companies that, yeah, like that's equity is good. We should look at companies that have, um, that trade at reasonably close to their net asset value. So go to the
Valuation?
evaluation, and then it would be price to book.
What? Like
We want like
this? What?
between, yeah, like less than 1 and 1 to 2.
Less than one, two?
Yeah,
Yeah, yeah,
and
of
then
course
this
it's that
is,
one. This is a good metric. Yeah, I forgot. Yeah, of
yeah,
course.
yeah, yeah. And then this should be good. Like all these companies should be valid.
Okay, but then let's see this. Shouldn't we also have like not as a criteria, but cash flow per share?
Yeah, but
Okay, I
I
guess
don't
we
get what
just
this
saw. Yeah, we
means.
just saw that they can have negative cash flow.
Yeah, but also
Okay,
like cash flow per share is not free cash flow per share. I don't know
right.
what the
That
metric
yeah,
is.
yeah. I forgot about that whole thing of not knowing how they measure that. Okay, okay. Yeah, let's see. Yeah, we continue to not have O. Is it because we didn't change the growth thing?
No, because O trades at a premium to book value, which
Oh,
makes
that's
sense
why.
because they're the most attractive in the industry.
Okay, but
We're
we
looking now for
also
value.
yeah, we
Like this
also,
is
by the
gonna
way,
be
we have the dividend growth rate above 5 for all these, by the way. I don't know if we want
okay,
to
let's
change
change
that.
it. Yeah,
Oh,
we
no,
can
no,
change
no,
it
no,
to
never mind, never
GRP
mind. No, we
one.
did, we did change it. We did change it. It's just
Okay,
positive growth. Okay.
okay, perfect.
Mm,
Um, right, so now
now look at that.
this is like, so if O is the quality
Oh,
at
okay.
if O is quality at above average price,
Yeah,
then this is value. This could be
right.
considered value, you
So,
know?
yeah, check this out. This is the lowest price to, well, not the lowest, but a low price to book with a dividend that increased 15% in the last year or in this year. And then they've had growth above 5% for the past 10 years. Could be good. And dividend yield of 6, 15 billion, healthcare rate. Ooh,
All right, check it out.
residential homes. Let's see.
Don't check it out. Don't check it out. Add it to the list on the Excel
Ah,
sheet.
to not waste. Yeah, okay.
Yes.
Okay, okay.
We're
Fuck.
past the checking it out phase. I mean, we're not past it. We haven't reached it yet, really, is what's happening.
Yeah, I mean, we did get cut a lot. We still keep, oh,
Yeah, we'll
right?
keep Owen in that. It's just,
Yeah, it's a reference as well. Yeah, okay. Cousins properties. You on the cuss? Fucking dead. All right, my bad. Let's see. Hmm. I'm doing you to year. The equity. I
sort it.
mean, this is pretty good too. High 10-year dividend growth rate, even though they're
Yes,
like the slower. Debt to equity is
sort it
low.
by
This seems like a more conservative one, which is why the price
sort it
still
by
go
what they do. Go to the left.
by what they do. Oh, to have them all in
Yeah.
the same kind of, what would it be like industry?
Uh,
Yeah, because sub industry is the same every time. Okay,
like, yeah.
yeah. Do you want to be able to see
Uh,
it every time?
no, the sub industry, the sub industry.
They're the same thing, brother.
Are they? Oh, they are. Okay,
Yeah.
okay, okay. All right. Yeah, so now we get one from each.
Okay, so then Alexander and Baldwin from Diversifier reads. I mean, just because it looks like a strong one, they're not
Yeah,
like,
yeah. Yeah.
like 18% 10-year growth. And it's like there's not really growing it like much, but it's like a low debt to equity. And that's why they're trading a little bit higher. Yeah. I would rather have this than this, is what I'm saying.
Right, so add it.
Yeah. Okay.
Alex.
Alex Jones. All right. Next one, we have R already for healthcare. Now for industrials, we have 1, 2, 3, 4 from GRP to TRNO. Okay.
I've heard good things about Prologus.
What is that?
Prologus.
PLD?
Yeah.
I mean, they do look pretty well. 3-year growth of, well, I mean, this one looks better, actually.
I think Prologus
Look at this.
rents. I think Prologus rents to Amazon.
Okay, but this, okay, I mean, we can add that, but this guy, just because you mentioned Pro, is better on every metric.
Yeah, but they're not better on the metric of quality of tenant.
Well, we don't know. We don't know
Yeah.
what they do.
But I'm pretty sure that's what it is. I'll look it up. Hold on.
Okay, I mean, we'll add both. Definitely the better ones of the four. Yeah. Maybe this would be the one that is more conservative, actually. With that 0.19 debt to equity. They've grown the dividend 12%. They all look nice in their own ways. Yeah, I like this Trino one too. Torino. 6 billion. Rex is 10 billion. Right. PLD is 103 billion. Let's be fair here too. Like PLD
Amazon,
is growing.
Amazon,
Is growing kind of at the same rate
Amazon.
with a much larger market cap.
Yeah, their biggest. Yeah, these guys are legit, bro. They
PLD,
rent
yeah.
offices to Amazon, Home Depot, FedEx, Walmart, UPS, DHL, Geodis. What's the
Oh,
other
you're
one?
talking
What's the
about
other one?
Rexford or Prologis?
Prologis.
Oh,
What's the
okay.
other one? Rexford?
Yeah, REXR.
What's the full name of the company?
Rexford Industrial Realty. 10 billion market cap.
REXFORD.
Yeah. I like
It's thinking.
Torino too. I like Torino too. It's just like it's not as impressive in terms of. I mean, it is pretty impressive still. It's just that dividend hasn't increased like a lot at all recently in the past 3 years.
Yeah,
It's
these
just because of
guys
this that I like, but yeah, I mean, I guess.
in these guys are focused exclusively on infill Southern California markets. 420. They're much smaller, it looks like.
Yeah. What is infill? What do you mean?
I don't know.
Oh,
Infill?
infill.
Infill. I don't know.
What can you ask?
No.
Okay, you just want
Um,
PLD. I mean, I don't care if they're in a local market. I don't like what's the big deal with that.
manufacturing, wholesale trade, logistics, e-commerce. No, but the problem is that they don't even. There is no notable tenants. It's just like small. It's smaller. It's much smaller. It has to be. What's the market cap of these
That's
companies?
bad for us. Yeah, it's 10 billion. It's mid.
1 billion versus Prologis, which
A hundred,
is
100 billion.
100 billion.
No, I get it. Like I get that these rates are much more impressive for PLD, being at the size that they are.
Well, not just the rates. I'm saying like tenant composition is probably like one of the most important metrics. So it's
Okay.
like if you rent,
Okay.
if you're a $10 billion company
Mm-hmm.
and you rent to a e-commerce company that, like
Yeah, I get it.
they're like
Like we don't know
yeah,
who these
like
people are renting from Rex. We don't know. It's gonna be harder for us to figure out the good tenants and such, right? Kind of thing.
exactly, yeah.
Okay.
Exactly.
Okay. So yeah, PLD. At the end of the day, yeah, it's not like we're building an only real estate portfolio, so might as well not get into the weeds with that infill regional company.
Yeah,
Okay.
what the hell is that?
Okay, PLD.
I'll ask it now. What does infill mean? Infill refers to properties or development projects located in densely populated urbanized areas
Hmm.
for new construction.
Okay. So then, like in cities, that's cool. I mean, look. The thing is, yeah, that was impressive is how much they've grown their dividend, and the fact that they're at a
Yeah.
low debt to equity and
What's the yield for both of them?
4.03 for Rex and 3.6 for PLD. So it's like
Right.
again,
So
PLD at a higher
we've
market.
arrived to the same. Yeah, we've arrived to the same. All that growth and for what type shit?
Oh, ah, okay, fair. Yeah,
You
I
know?
guess. Yeah, sure.
And it makes sense that they were growing faster because they're smaller. Now, eventually, those growth rates will come down.
Yeah, no, which goes back to yeah, PLD is more impressive on having like a similar growth with a much larger market cap and therefore a much larger dividend. Okay,
Yeah.
PLD.
And their tenants are like not
Yeah,
big,
right.
to be honest.
Yeah. Okay, office. We only have one, which is the Cousins. It's a small cap of 5
Cousin.
billion and pretty mid. I mean, I don't feel like we need to include them even if they're the only ones in the sector. Because what is this? I mean, I guess
Yeah.
dividend yield is all
Don't
right,
don't
but
add.
everything's like a pretty mid growth.
Yeah,
I guess what would
we
be
don't even
good for
have
these
one of them.
companies too. Is there a way to check? One second. Like when, like how old these companies are? There's no way to put that in
Oh
here.
no, not from here.
Okay, well, it's fine.
You just have to check the blurb or
The blue
whatever.
little.
Yeah,
Wait, if
is
I
it called
click
a
on
blurb?
this, it will tell me here without having to. Oh, no.
Nah, you have to open it up.
Shit, whatever. Okay, ADC, agree. Well, we have
These are all
retail, so
these are
three
all retail.
retails. NNN, Getty. This is like John Getty, must be.
Who's John Getty?
John Paul Getty. That's the guy. He's like a oil magnate. He's the guy behind Getty Images. Well, he's dead now, but you know. But nah,
Oh,
this
really?
kind of be. I mean, maybe he's a son or something. $2 billion micro
It
cap.
could be.
Yeah, somebody related. I mean, they have a pretty high dividend yield with a stable growth. Yeah, I mean, they look good. I mean, yeah, just
What's
yeah,
that last
just
thing? What's
they
this
all
last
look like
metric?
they were well priced. That's the thing. What?
Is this price to
Getty?
book?
Getty.
Yeah.
Getty.
No,
He
I'm
wrote a
saying like
book too.
the last metric is
Oh, my
price to
bad.
book.
Yeah, this is price to book. Yeah.
Hmm.
I mean, again, this is
The one at the
PLD.
bottom looks pretty interesting. Why is it trading at such a steep
Sorry,
discount?
premium. No, is that a discount? Oh, you mean that land, the one? Okay.
Yeah.
Specialized. Wait, this way, I guess. I mean, it's 320 million market cap. But
Right. That's
yeah,
what we wanted.
I mean, they're not decreasing the dividend in the past 10 years.
And they're trading at a insane discount to book, man. Half? It's crazy.
That's fair. Okay, it must be. Well, let's see.
Let's
And their
take a
fucking thing
quick
is land. It's kind of sick.
that's pretty
You
good.
can just own land. What do you own? I own land, bro.
On land. Oh, look at that stock price.
Hell yeah, what just happened, brother?
Ooh.
What do they
But
do?
you mean to tell me that their price has been going like that and they're still growing their dividend, but everything says to avoid them. Why?
Yeah, yeah, I see
Something
that
bad
too.
must be
Yeah.
happening.
Well, not LSEG. These people always say buy, I think, though.
They don't know. All these things are trash. Genuinely. All right, let's see.
Yeah, I mean, they
Their
just
dividend
never. Yeah,
hasn't
they're
been
not doing.
increasing.
Yeah, look at that. I mean, I guess we can check on ROIC to see longer ones, but
Oh, this
yeah,
is beautiful.
yeah, that is beautiful actually, because that means we get a better yield, and then not the and it's monthly. Look at that
Mm.
compound. Great.
All right,
Okay,
let's look at the balance sheet. What's going on with the balance sheet?
okay, one second. Let's see. Net
You said
profit
this company is worth 320 million, right?
return on equity of -2. Okay, sales per share. Long-term debt to equity. Yeah, okay. Nothing is like. Okay, but first I wanted to check what the fuck it is that they do in terms of it says specialized rate. Uh oh, you're not gonna tell
Down.
me what they do? No, they
No,
don't.
it tells you. Keep
Where?
going.
Oh,
Right there.
oh
Oh,
no.
wait.
Oh, here,
Right
here.
here.
You're right. You're right. 1997 Gladstone Land is a publicly traded real estate investment trust that okay, that acquires and owns farmland and farm-related properties located in major agricultural markets. Owns 150 farms, comprised of approximately 103,000 acres, 15 different states. Okay, so it's farms.
Yeah, okay.
Okay.
They're like a modern day
Mainly in Cali.
serfdom. It's like a modern day serfdom. They own a bunch of land and they just have people work the land.
Well,
W.
sure. Fair. I mean,
W.
okay, I feel like that's every real estate then, I guess. Well, no.
No.
No, you're right.
Well, these guys are like, look at
They're
this.
specific in the farming, yeah. Yeah.
They got
Originally,
them
tenants are
farming.
able to grow fresh produce and annual row crops such as berries
Yeah,
and veggies.
they're forced to pretty much.
The company also owns
And
farms.
mind
Uh-huh.
you, they pay them. They pay them. They don't pay.
What do you
They don't.
mean? What are you laughing at? What do you get? What do
They
you?
have people. They got people working the land,
Uh-huh.
and then they pay them from the.
Oh, like they pay a rent to use the land.
Yeah,
I mean, that's how it
they
was
pay
with
rent.
serfdom too, right? Like the laborers or whatever. You have to
Yeah,
pay
yeah. I
to get the
mean,
land, and then
to
they.
be honest, yeah, it's not like serfdom because obviously serfdom you keep the crops. Like the guy, they get nothing. It's like
No, no,
these
but I
guys
think
own
I
the
think it is
land.
kind of similar to what you're saying, which the people would be working the land, and they would have to pay to
Yeah,
work the land, and they would keep like a little bit of it. So it is
yeah, yeah.
similar.
But they keep a lot of it probably because they keep all the they grow all the produce. Like they keep
No, but these people
just the
don't.
produce.
These people just rent the. Oh, you're
They just rent the
saying,
land. Yeah,
yeah, yeah, like the
they're
people
yeah,
actually
they're
renting it.
flattened out.
I don't know how much they keep. Yeah, maybe they don't keep that much actually, and they gotta pay a lot in renting only just for the land. But I doubt it. Yeah, like I doubt it. Yeah, they probably.
It's
Yeah,
definitely a mutually beneficial
yeah,
relationship.
yeah, yeah. We're not in the Middle Ages.
They're,
I don't know why the fuck I'm negotiating that.
yeah. So yeah, let's go to their balance sheet.
Okay, one second.
Organic, everything's organic.
I mean, why wouldn't it be? Why is it only 30%? 20%? Oh, like it can be like modified, like whatever,
Yeah,
like.
or whatever
Oh.
non-organic. Really, I don't know.
Yeah, I assume non-organic maybe means like if it's like genetically modified, which is most
I think
food.
also, I don't think it can also be like if it's sprayed with certain fertilizers, it's also considered
Oh,
non-organic.
gotcha. 147 consecutive months of cash distributions on its common stock since the initial in 2013. Isn't that longer
Right.
than the fucking O, guys?
12 years. No, no. Oh, it was like 30 years, bro. More than 30 years.
But I saw something
147
about
months,
the months.
like 12 years.
Ah, 661. No, no. Okay, let me just walk that back.
Mind
Um,
you, that's not even like it's like 50 years, bro. It's crazy.
oh, why is that? Well, because a bunch of debt. But then,
Yeah,
wait, but this doesn't add up
why not?
because then that would mean that their debt to equity is more than double, but it's just like 0.8. No? Am I
Click
reading it
on
wrong?
Click on their balance sheet, bro.
Yeah, okay. I don't know what I'm dilly-dallying about. Okay. They don't have much cash.
They have. What do you mean they don't have much cash? They're a small company, bro.
Yeah,
This is like
18 million, right?
5%. Yeah, it's like 5% of the total.
That is 5%. Okay, but that's not much. Is it?
Yeah,
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 okay.
man. You don't need that much cash.
Okay, okay. I'm not saying it's a bad thing. I'm just saying, okay, whatever. I don't know what I'm saying.
There was a certain, you know, tone that I sensed.
No, fair. It did
Maybe
sound
how
a
they
bit like
manage
that,
money.
but it wasn't too charged, you know? It's just like a comment, and then, you
Yeah,
had to
let's see
press
it.
on it and make me look like an ignorant ass, bro. I was just saying they don't have much cash, bro.
So total liability is 625. Their book value is double their market cap. And then it makes sense why, yeah, their enterprise value is high because they have a lot of debt, but they have, yeah, this actually looks fine to me. Their liabilities are also going down,
Yeah.
which is nice.
I guess we could check their interest expense and stuff if it has
Yeah,
also
let's
been
look at
going
their
down.
look at the cash flow statement. Wait,
Why is the return
yeah, total
earnings going down every time? Cumulative deficit.
because
They've
they're
been losing
giving,
money the whole time. Well, again, but this is on an income basis, so it doesn't. I guess it doesn't matter as long as their
yeah,
cash flow is fine. But yeah, but I guess 1 second. Let me check that. Where is income? No, but then. Oh, income available to. Why? Total adjusted. Total adjusted net income. Why?
go up to the top,
Uh-huh.
up,
Oh.
to the very top. Right now, okay. Um, Operationally, they're fine. Okay, let's scroll down a little bit slowly. Sure. Interest expense is high, very high.
Wait, is it?
Yeah,
Why? I don't get why you're saying it's high. Compared to operating income, is that what you mean?
yeah.
Okay.
I mean, yeah,
I guess
pretty
what we
high.
can check is kind of the rate is what I was going for. Like if the rate at which they're paying their debt is going up, but it seems like it's going down as much as the debt. But 22 million interest expense on a debt that is 500, 560. What is that then? 600, let's say, and there's like 20 out of 600.
3%.
Yeah, I mean, sounds right.
Yeah. Chill. It's chill.
It's chill.
What's the depreciation expense? They
Well,
put
that
on the
would
same
be.
trick. No, it's there too. No.
It's an income statement.
Yeah.
Oh yeah, yeah. Yeah, I mean, why wouldn't they?
Yeah. No, it's good. Same tricks. Doing tricks on it.
Not a trick, bro. It's like the
Yeah.
farmland gets like, the
Oh.
life of the
Oh yeah.
soil, bro.
Ooh.
Actually, it makes more sense
Yeah.
on farmland, to be honest, for it
Oh
to
God.
depreciate.
Yeah. Wait till it sells for like a 300% return in a couple. Like we don't know what happened. We were devaluing the property, but I guess nobody else was. I don't know. So weird. That's gonna be what their investor relations page is like. Oh, yeah, we don't know what happened. I mean, somebody was just really interested in buying the land. It seems we we've been depreciating this asset for 10 years at a 20%
But
rate.
it seems
It's
like
worth
they
negative
want to
money,
pay
but
300
somehow
times
somebody paid
more.
us 5 times the amount. So peculiar. Oh well, here's taxes from it. Government takes the money, but then it's giving him like a side eye. He's taking the money and is like, all right. I guess we're good. I guess we're okay.
As long as you're paying us. Yeah, here it
Yeah, I
is.
wonder if there's studies that are done about the net tax effect of
Mm.
like
It
would be
must
the
be good
total
for
money
Calvin if
paid.
they're now
Yeah, the
persecuted.
total taxes avoid versus the total taxes paid
Yeah,
upon completion of a sale, like
yeah. I think it's fine. Yeah,
my guess would be that they are saving money over the long term by doing
yeah,
these tactics.
yeah.
Anyway,
I
I
don't
mean,
know.
you know why I think this is a scam, and
Why?
like I might be outing myself here, but I did the same thing for my cars. I've been depreciating my cars by like
Right.
with like a straight line depreciation method for like 3 years now, and
Uh-huh.
like my cars are worth way more than the carrying value that I have them listed as. So it's like,
Yeah, I guess the
you know,
reason for that is like the market is so like I guess the argument for depreciation being independent from market value because there are some assets that you just have to do a fair value assessment and then do impairment or not. So it's like especially with like
yeah.
newer assets. So I guess
But you
that's
don't,
why.
like you depreciate, like there are assets that truly do depreciate, right?
Mm-hmm.
And then like, cause you don't, nobody, like when these companies, for instance, hold stocks, they
Yeah.
don't depreciate the stocks.
Right, because they don't depreciate. They're not assets. Same with software; it doesn't depreciate.
But neither does land.
No, but that's the part I'm like, I think it does to some extent. I mean, real estate, if it's a building, it does
You
get,
can
you have
say that
to,
it does, in that it is like it's like assets that are like it's like plant, it's like property, plant, and equipment.
yeah. I mean, any asset that you need to spend money to maintain depreciates because you need to spend money to maintain it. Like
I
depreciation
suppose, yeah.
is just like kind of, yeah, like elongating or you distributing that capital expenditure through time. That's the
All right,
point
let's
of
go
it.
into the cash flow statement.
Okay, okay.
Let's see how they're servicing their interest payments,
Net income,
their dividend payments.
cash interest paid. Wait, what do you mean? Is this it? What do you mean
Yeah.
cash interest? No, but cash interest paid. Now this is paid on the debt, right?
No,
Yeah.
no, this is their,
Oh yeah,
yeah,
this
this
is
is
the
their,
debt. Okay, okay,
oh,
okay.
this already, yeah.
Because it's equal as the interest expense. Yeah, okay.
Yeah, so these guys are actually free cash flow positive.
So I guess yeah, I mean
So they're
mainly
fully
because of this
funded.
baby boy, which again, but it makes sense because this is not a real expense. Yeah, yeah, okay.
Yeah, it's full fake.
Sale of fixed assets, right? And then they can just sell whenever. And
So
they just
it
sold
looks
a
like
bunch actually.
they've just come out of
Yeah.
an investment
Whoa.
phase. Yeah, it looks like they just
Yeah.
come out of an
Wow.
investment phase,
And it's time to
and now
sell.
they're just generating cash, which is good. I mean,
Yeah.
it looks like they're a couple years ahead of where O is right now.
Mm. I like it. I like it. I think we should add it.
Yeah.
It's small
But
enough
so then
also that
why
it's under the radar for a lot of people.
yeah, but then why is the stock down so much though?
Oh, I guess we can check that too. 1 second. The cash from financing. Wait, what is this now?
Honestly, just ask Grok,
Oh yeah,
see
okay.
what's going on.
Hey, Grok.
Don't say hey, man. He's
Can
not even
you?
Grok, brother.
I know, but let's see what it says. Can you do an analysis on? Can you? Oh yeah, actually, let's just go to the same chat so that we don't have to.
Double it.
Okay, now analyze company figure and give me an assessment of the current market valuation. Why it has been going down for years or I mean, it has been going down for an
Years.
extended period of time. Search the web. Damn, he's much quicker now. All right. Okay. Yeah, this is it, right? Yeah.
Mhm.
Gladstone is a farm loan rate, fixed based rents, participation rents, so they share in crowd. There we go. They'll feast them. Occasional other income, lease termination fees. They also grow their value via land appreciation or depreciation. Farm as an asset tends to appreciate, contrary to accountants
Mhm.
accounting belief. Especially
Classic.
specialty cropland, if water rights, location are favored, they are distribute. Yeah, okay. Recent
Right. So pretty
performance.
much the value of their rental income, the quality of their rental income has changed because they're going from a straight payment system to a
Oh, you
sharing
already
system.
like ahead. Oh, I see.
Yeah.
Shifting somebody from fixed base rents to work with very. Oh, okay. So that people don't like that.
Yeah, because it's less stable. I mean, because
Okay.
yeah,
Yeah.
like
Okay. Fair.
but
Yeah, it
it's not
must be
yeah,
because they're
I mean
having a
it's got
harder
both
time.
aspects of because like obviously if your tenant's not making money, they're not gonna keep paying rent.
Hmm.
I don't know, it's a little bit
I mean,
weird,
we can
right?
check how how their revenue is responding to that strategy.
Yeah.
I mean, they're doing fine. This new
Look
system,
at
it seems to be working
income.
fine.
No,
Yeah,
go to
yeah.
the income
Fair,
statement.
fair, fair. But I
The
assume it's.
revenue is
Yeah.
falling. I mean, not really, but it's changing, it looks
Yeah,
like.
definitely not going up. I mean, they're just
Try to get
efficient
a
about
longer
it.
try to get a longer picture, like go to ROIC and
I
see longer term.
wonder if this. Oh, they just become more efficient on it. Yeah, that doesn't really help us.
They
Okay.
have become more efficient, it looks like.
Yeah, but this is not on the basis of their contract. So it's like if this is going up on a lower revenue, which it is, the cost of revenue, that means that the rentals contracts are
No,
worse,
it's no, but yeah, I mean,
right? Like the quality
the
of their
average,
contracts, the company
the
is becoming
growth,
more efficient, but the quality of their rental contracts.
the 5-year gross profit margin is increasing though, it looks like. No? No,
No,
it's
that's
not.
it kind of be. I mean, I don't know about. Yeah, I mean, I assume not even, but like it just
Not.
if this is going up and this is going down, like
But
just on that
that is
basis.
a very healthy gross margin though.
Yeah, sure. I mean, again, it's not like they're
Mm.
selling any product. I don't even know how you would like. What is the cost of revenue? I guess the cost of acquiring the contract, like the cost of of getting the rental contract, and then this is the money you get from the
Ye-
rents. I guess we can ask
Yeah.
that. Like, what is the cost of revenue for this company? But
No, no. Can you go real quick
right?
to the
Yeah,
ROIC? Yeah,
that's about anyway.
before we do this next thing.
Yeah,
And then yeah, they might not have the stuff for it because it's too
fair.
small.
No,
But let's see.
that's land. Oh, they do. Oh well.
Financials.
Yeah, yeah, they do. Okay. We're
Yeah, look at
looking
that.
at gross profit margin. You want to see? Maybe we should go to
Mm,
ratios.
mm.
I just want to see the gross profit.
I just want to see the revenue.
Wow,
Yeah, so it looks like now for the first time in their history
they've slowed
is
down significantly.
slowed down.
Yeah, but then again, but if we
Uh,
look at the stock price, why it's not like it's not showing up like it just slowed down. This is the wrong one. Yeah. Okay. Okay. I
you'd have to
just
close this out.
whatever.
Yeah, this is better. Max.
Yeah. So it started in 2022 to decline. Also, why did it go up
Yeah,
so much?
the writing was on the wall.
2022.
But I don't think the fundamentals show that
I mean,
that much.
it is after 2022 that they started.
Yeah, but it's really like it's not the fundamentals don't show that bleak of a picture.
No,
Like
yeah, no, I
5,
know. Like it not like to the point that like the value of the stock went down, even if we look at not even top peak, but like 30 to 8. So it went down like by 70%. And the revenue went down what? 5%? Well, no, 10%, whatever. But
yeah, no, literally like 5%. Well,
yeah, fair,
six,
fair,
seven
actually.
percent,
Yeah. 6, 7.
6, 7.
Fucking fool.
Yeah,
Um,
man.
yeah.
Yeah, I think it might be good. Might be
Yeah,
not
I
bad.
think definitely worth looking more into. But yeah, it's like what you're saying. It's like gross margin has gone down, but it's a 95% average.
Mm-hmm.
So it's like, yeah, but is that why? Okay, let's keep reading because it seems like a lot. Revenue drop, right? And missed estimates dropped 42% year over year. Is that true? We're on the quarter. Oh,
Q2 25. We don't have any
uh,
25 data. Oh, yeah, go quarterly.
yeah. 1 second here.
Uh-oh. Uh-oh.
Ah, oh boy. That's
So for
a
this
big
year,
droppy.
it looks like they're on track to do 60, right? It would be like 60-ish. Yeah, that's bad.
Bro, but these people keep lowering the fucking. They become a very efficient company though on the fucking end of this. They're
Yeah.
just compensating with crazy cuts and shit, which yeah, it doesn't
60
really mean it's
million. 60
great.
million is crazy, bro.
Oh,
From 85-90 to 60.
wait, what are you talking about now?
I'm just
85 million.
extrapolating what their yearly revenue is going to be based on those 2 quarters. Like,
Oh,
it looks like around 60, man. Maybe less, low
60?
key.
Oh,
Well, yeah, because 16 and 12 is 28, and then if
mm.
28 and 28, it's around 60.
Ah, yeah, yeah. Okay, one second. Can we check the quarterly here? Oh no, right? Yeah, okay, okay, I forgot.
This
Hmm.
is, yeah, this is much more bleak than originally anticipated.
The missed on revenue and EPS. Negative adjusted funds from operation. Adjusted funds from operation turned negative, meaning cash flow from operations is not covering expectations costs. Oh shit. Okay, one second. Let's do that. Actually, quarterly, right?
Mhm.
What do
Mm, well, this is cumulative, remember? So
you mean it's cumulative?
it's cumulative for the year. So it'll be about half of what it was last year at
What are you
these
talking about?
current
This is not a balance sheet. Why would it be cumulative? What are you talking about?
It's cash flow.
Yeah, it's for the 3 months.
The Q2,
No?
no, it's for the six. Yeah, it's for the 6 months. It's fucking. It shouldn't be. I don't think.
I don't
Mm,
think so, bro.
it
Look at
is. It
this, bro.
is.
Bro, what are you saying? How would it be 12 and 13 and 1270? What are you talking about? Like what? They added 1 cent of income here? No,
No,
man.
the cash from operations.
It's the same, bro. They're in the same column, bro. Like, what are you? What, like, they went down 3 million in cash?
Like
It's no, it's not cumulative, bro. Like,
it is cumulative because look at
it's
like
quar.
look at
What? Are you,
so
it's a period of time. What are you talking about? I'm confused. How could it be? 12 cash from investing? Or what is going on here? You're saying they're going up 2 million and then or down 2 million and then 3 million up?
yeah.
No, bro, there's no way. And then also, what would it happen here from Q4 to Q1? Is it like all trailing 12 months all the time? Bro, I don't even know where you're getting that from. Like, is that like where do you get that information from? Where did you see any of that that would suggest you?
Yes.
I feel like you're tripping, bro. You're tripping me out.
I'm not tripping, bro.
How? Why do you say that is like cumulative?
Like for instance, that Q4 there
Huh?
is it's it's all 4 quarters.
No, it's not. Why would it be?
Just the just the cash from operations, not the rest of it. Because
How?
does everything in there add up to 30 just on the one line? There's 13 plus 35 minus 350. Does that all add up to 30?
I assume. You want me to actually check it?
Yeah,
Why wouldn't it add up? Bro, it definitely does. All right, let me do it.
check it.
Yeah.
Yeah, just check it real quick.
I feel
Just
like
for
I'm
my own
going down some
sanity.
rabbit hole, bro.
Bro, I'm telling you. I think in the past I've looked at the investor relations versus the thing, and then it's like when you
No,
look at the 6 month on the
I
investor
mean, when I said
relations.
that it does, then I look at the numbers. I'm like, I don't know, maybe it doesn't, but I'm like, how can it not? And then I'm actually adding it up now
I'm still telling you, it's fucking weird.
because it is. Yeah, I mean, let's see,
Something's not adding up, man.
let's see. But yeah, let's see.
Yeah, yeah.
That's so wild if that's true, bro. Schwab should get sued. Yeah, no, it isn't, bro. What the fuck is this, bro?
Yeah.
But then it also is in the past 4 months or the past 4 quarters. What the fuck is
It is
this?
it is the password. No, no, no. So
No, but
listen, the
look,
line,
is it
listen,
Q1 is negative somehow?
net
Or?
income, all the line items, net income, depreciation, all stuff is 1 quarter.
Total cash from operations is on a rolling basis.
Okay,
Just
wait.
that.
1216 plus 17.97 is 30.13. Bro, get the fuck out of here. Why would you why would they do this? What the fuck is this about? That is so annoying.
I know, bro, I've been down this rabbit hole before, and I've just accepted it, and that's why when you were questioning me, I'm like, shit, maybe I'm retarded. But I swear,
Because it is retarded, right? Yeah, it's not you that is, it's the fact.
yeah, I've been down this rabbit hole before, and I was
Oh
so
my
fucking,
god.
and I was like, how is it possible? And then I would go back and forth between the investor relations and the fucking Schwab, and I'm like, oh, it's fucking the cash from operations is cumulative, but the line items are not. It's like, it's yeah, because they're using. I kind of get it. Like I kind of get it because it's like it's when they break it down quarterly, they can't be asked because they just put the number in from when it's the yearly, and the yearly is obviously all of it together, you know? Because look. So Q4 24 is 30, right?
Right, and if I go annual, it's
Which
gonna be
means
30, right?
oh, annually it's 30 again.
Yeah.
Yeah, you see.
No. Again, now I'm seeing that that's the fact. I'm just trying to understand how they got to that being a good decision here.
Because they just
And
can't
also
be
not
asked.
say anything about it, like not even a note or nothing.
Yeah, they're not interested in you know explaining themselves.
I can see that. Yeah.
But I just
That
I've
is
been through it.
weird.
I've been through it, man. I've been I've gone
Okay,
through it
I don't
before
even
for
know
sure.
what to do with this now. I don't know who to trust. Like,
Well, all you need to know is that for the 6 months in 2025, they produced that much in cash from operations,
yeah, okay.
which means they're on track to do around 16, which is half. Um, Actually, when you fully accept it, when you let go,
It is useful, is
then
what you're saying.
you're
Because
kind of
that
like,
way I
oh,
can compare this to this. I guess that's why.
yeah, yeah, type of thing.
I mean, I could have done that even if it wasn't added up, but yeah,
You just
fair.
let go and just kind of give yourself to
Yeah,
that,
just
and
embrace the
then
fucking
tell,
nonsense.
yeah, then it's like, okay, well, that's kind of nice, I guess. I don't have to do much addition.
Okay. Let's keep reading the reasons. But yeah, I feel like we should just drop it by this alone, right?
Yeah, I
High
don't like
cost
it.
of capital, interest rates, asset sales, vacancies. Some farms are
It's a
vacant.
shame. They're gonna
Ah,
look great.
they've sold some farms. It seems like there's not enough farming in the US going on because they're having a
Yeah,
hard time renting them. That's why also they probably moved to like variable rates. Just
yeah,
try to
tenants
get
can't
track more
afford
people.
and start making enough money.
Yeah. And then the fact that,
Yeah.
they're kicking out the Mexicans. So it's like, who the hell is going to work the farms that they rent?
Hmm.
Yeah. They maybe the book doesn't reflect, but they can really realize, right? There it is.
Yeah.
All right. Well, then we're not choosing that one. And then we still haven't chosen one from these three for retail.
We haven't? Oh no, we said none
Oh,
of
but
them, right?
look. Oh, no, this is not price to book. No, man.
It's that. I think we said none of them, no?
Oh,
Or
we
am I
did
bugging?
say none of them? No, I think that was
I
just
think so.
Cousins. That we're not gonna pick Cousins, even though it's the only office one. I don't remember why actually. Oh, because he didn't really have any growth.
What about
But then
Apple
again, I mean, it's actually
Hospitality,
not
bro?
that. What?
Look at Apple
I feel like
Hospitality,
you
right?
told me about that company some time ago.
APLE. Oh, this is like one of the bro. No, APLE.
Yeah, here it is. Apple.
Dude, this is one of the first. This is one of the first ever stocks that I owned, bro.
Apple.
When I was like 20 or something, and it was literally like just a thing of, oh my God, they pay me a monthly dividend. Like I did, like you know what I mean? Know anything about anything, and just the fact that it paid a monthly dividend, I was like, wow.
Why are you showing me that? I'm so confused.
I think they cut their dividend, bro. Like let me see, because this used to when I owned it, it used to trade at like 18-ish.
Oof,
Yeah, look at
that's
that. Yeah,
rough.
completely. Yeah,
That was COVID.
yeah. Yeah.
Damn, Daniel. Well, then again, I feel like because they just pass through the whatever they get from the rents, right? It's not like they even cutting the dividends themselves. Just
Yeah,
people just not paying them. Right?
this company owns like hotels.
Ah, yeah. Well, that definitely makes sense for COVID.
Hmm.
Well, the stock didn't even go down that much. Well, never mind. That is a lot, right? Where is that? 60%, 70%?
Yeah,
Yeah, from
I
like
just
where is this?
just
15,
looking
16?
back,
Yeah,
back at it.
60, 70%.
It looks like they're doing better. They just
Yeah,
reinstated their dividend
I mean,
back
how can
growing
they? How
again.
can they not? Yeah. I
On
mean,
track
again,
to
they don't
grow
have a
again this
choice to
year.
reinstate the dividend or not. They have to pay through whatever they make.
Well, yeah, but most companies keep their dividends in these scenarios because they of the
Oh,
the visual
oh, like
aspect
the
of it,
other way
like
around, like the fact that they cut it. Yeah. Okay.
was like a signal. Yeah. Because companies, you saw what happens. Like they'll just take on debt to pay the dividend in the meantime when they're
Huh.
doing other things.
All right.
It
That,
just in the
what
name
did
of
they
keeping the
do?
dividend.
What did they do during that time? Did they raise that?
No, probably they didn't because they cut the dividend. They just said fuck it.
Okay, I feel like we should just move on though after checking this to a different sectorini.
Oh yeah.
Wait, this goes the other way around, right? Okay, so 2021. Yeah, they didn't really do anything special with the debt. Nope. Not
No,
even
I'm
a
telling
little
you,
bit. Yeah, yeah.
they just refuse. They just refuse to do what other companies do,
Yeah,
which
fair.
is maybe a good idea,
I
honestly. But
mean,
it did it did like destroy their
yeah,
stock.
that's what I was gonna say. They paid the price.
They paid the price. But to be honest, I think as from an operational standpoint, I would prefer that
Yeah, I see what you mean. And they're
than to
doing
just take
better
on
than the
debt.
competition now.
Yeah.
Right,
Well,
because
because
now they
exactly
don't gotta
right. Like
service that interest on the debt. Right.
exactly. Yep. Yeah.
Yeah, that's fair.
This is
Price to
probably a
book,
situation where like the management doesn't own too much of the stock. They're like, you know what? Fuck it, man.
the trading below book value. Price to sales is high, I guess. Price to earnings is
Yeah, but
low. Hmm.
and I never use this, by the way, because what are these other, like, you never know what these
Oh well, yeah.
are.
I guess we can't trust these people anymore.
Schwab populates with whatever. I remember, what was the thing where it populated the most random shit as competitors for it? And I'm like, all right, yeah, this is
Oh,
cool.
you mean the competitors? I wasn't even thinking. I thought they were just populating these metrics, whatever. Yeah, like this
Yeah, because,
actually 17-month metrics.
yeah, and oh, yeah, it's like, oh, no, this is not 1 year. You thought this was one. No, this is 5 months. 1.6 quarters. Wait, we don't know
uh,
what's this company worth? What's the market cap?
oh my bad.
3
2.9.
billion. Okay.
Oh, yeah, look,
And
they look
so
all right. Yeah.
it looks good. Yeah, I was about to say like at a glance, but
Where is this?
look a little deeper.
Check a little deeper.
See, now these guys don't have that much cash,
Oh, right, I
10
see.
million.
Right, for their market
But they
cap.
have receivables. Hmm.
Mm, this is
Receivables from
rent that
what
they
though?
have.
Exactly.
For the rent that they have.
Rent. Okay.
But where's the current assets? Okay, just Schwab just giving up. They're like, we're just not gonna add
No,
it up.
they don't care. They're not
We're not
interested
gonna
in.
add it up for you. You add it up yourself, brother. Who
Like
knows?
it's
So,
right
so
there.
why do they all look the same too? Well, I guess. Oh, okay. No, that actually is fine because
It's
it's
just the
gross and then
same.
it's net and then it's okay. It's just total. Okay, fair.
It's two items.
They could just put one
Two
item.
items.
Okay.
Um,
And then again here, and then they just put it again. Why don't they care,
accumulated
Schwab?
depreciation is, yeah, it's normal, right? I mean, wait, yeah, okay, never mind. It's good. Is it? Wait, what does accumulated depreciation mean again?
It's just
Paid?
this is the depreciation for that previous period added up.
The total, yeah.
Yeah.
But I'm saying like when it's a line item like that, does it mean that it hasn't been?
expensed yet or no?
Like this is what it's for. It's so that you can get the net value of the property, plant,
The
equipment, and
total,
cost
yeah,
basis. Yeah.
yeah, but
Because
okay, yeah.
yeah, because this isn't going by period. This is just like what is the value of the property? You look at the gross value and then you subtract the accumulated depreciation, and you get this
Yeah,
is the value of the property today, which is lower. Oh, it isn't, but whatever. Could have been lower.
it it is lower.
It.
What are you talking about?
What way does this go?
We're
No, it
going.
isn't. No, the net value of the property is not lower. Just because I
Oh
guess
yeah, it's
they're
higher. Yeah,
acquiring more. Yeah, they're just
they acquired
yeah
more.
they're
Yeah, yeah, yeah.
spending more on the property than they're losing on depreciation. Fair.
Okay, so now go down. They have accrued payables double the size of their receivables.
Okay.
It's
Maybe
not
the construction like contracts.
not a big fan of that, but it's fine. And then
Fair.
total debt of 1.5. Yeah, so they're trading at a discount to book, right? From
Yeah,
what it looks
zero
like.
point 0.9. That price to book
Okay.
is 0.9.
All right, I mean, looks good. And then what about their cash flow?
Yeah, let's see how this has been moving. Oh, yeah, exactly. Like from since 2021, they've just been recovering and paying it off
Mhm.
to shareholders, which is probably reflected in the price, right?
Yeah, I mean, that definitely recovered.
Yeah. I mean, now they dipped here. Interesting. Which is maybe a good point to buy. But why? Why did they dip this year? Here. Well, dipped. I guess it's not that much of a dip. It's more continued.
Our portfolio should
Since
have
February until April.
0 to 1 of these types of holdings, honestly.
Okay. Yeah, I mean, it
I
is
would say.
true that we don't have that much money anyway. Okay.
Because it's like, what are we doing?
Yeah, right. It's like, might as well own bonds. Or I
Yeah.
guess dividend paying, like high dividend paying stocks. Anyway, yeah, like that's not the strategy you're going for, right? Fair enough. But again, but okay. We don't add it to the list since we're doing rates.
I like it. Compared to some of the other stuff we've seen, not terrible.
All right, well, let's just add it and move on, to be honest. And then we'll figure it out.
Yeah.
All right, we got materials and utilities. Oh. Okay, materials. Figure out what the hell materials is in the first place.
Utilities is easy.
Yeah, all right, let's start with that then.
Because
You
how
like
many
to
utility
start new
companies?
screeners, right? That's your own little thing.
Yeah, because we know now that Schwab is kind of.
Well, fair. We kind of trust it.
I'm telling you, I
No, okay, all right.
think I'm crazy, but I've seen it with my own
But
eyes that this shit just fucked
I mean,
up
you did just
random.
open my eyes a little bit. You
Shit just
can
doesn't make sense sometimes.
see if it lets me. All right, there we
Honestly,
go.
I've been looking into Fidelity to move some of my money over there because
I actually like Interactive Brokers research tools. I thought they were worse than
yeah,
Schwab. They're pretty good, bro.
well they are. What do you mean? What do you like about it?
They're better than Schwab. I mean, at least on the phone, you can check a lot of things. It's really well like organized. I thought it was gonna be less intuitive or something. I don't know
Well, you
what
can't.
tell you
They don't
exactly.
have financial data
They
though. They don't
do.
have like statements.
It's just a little bit hidden, but they do. Like the statements and stuff, it's all there.
Is it?
Yeah.
Oh, let me
I
see.
was looking at it through the phone. Like I can go now, I go to the stock and you go to company. Like I like they even have like a sentiment score on social media and stuff. They're like a bunch of
Honestly,
trading data.
the best thing is the tip ranks. Like you get access to the full tip
Well, that
ranks.
too, like you get
Which
like
is
the
dope.
analyst ratings and stuff. But then you go like financials, right? Then to the instead of inside of company, and there you go. You got income statement, you got balance sheet, you go to annual, and you get yeah, I mean, yeah, you get 4 years, 5 years, yeah, 4 years actually of financial data. And this is on the phone, so I don't know if it's better on the probably better on the computer. Like maybe you get more years.
I swear I could never find it, but I was always using Schwab.
I don't know, but that's what I was like. I thought like that it was better, but I've been using the interactive brokers one on the phone just to check a few things, and then I started to see that it's pretty comprehensive.
No, definitely. Listen, IBKR is by far the better platform. It's just the problem is, for me, the customer service is so ass.
Yeah. Right.
It really is a big thing, bro. Because Schwab, dude, every time, like every time I call them, no
Yeah.
matter what time of day it is, no matter what, it's always somebody that knows what they're doing
Yeah.
and that like can talk me through everything. It's like with IBKR, it was so much that they were following a script
Yeah. That
that
is
it was
annoying.
like it was pissing me off so much, bro. Because they outsource.
Pharisees.
Schwab doesn't outsource their customer service.
Hmm. Sorry, I
Anyway,
was checking
yeah,
something. All right.
utilities.
Utilities. Electric, gas, independent power, and renewable. So how is this different from energy? I'm so confused, bro. Well, I guess no, I'm not so confused. Utilities is like what distributes the energy, right? And the
Yeah,
water. Multi-utilities.
yeah.
What is this? Would sewage and stuff go on utilities? Right, yeah. Everything that's useful.
Yeah.
Okay.
Be like waste management.
Let's put the market cap so we can see it. Okay. Dividenzo. Yeah, right. We care about this.
Yeah.
Do we want it to grow? I mean, utilities, the things like they're so regulated, right? So it's like, what are we even looking for in utilities? Do we even care about this sector? Like,
Me
do we,
personally, no.
I don't think, like, why do we want to invest in utilities, to be honest? No, we don't want to invest in utilities. All right.
No. Right. Relax.
Oh, you do want to have somebody there? I guess, like, okay.
Well,
Like, just in case we get like a crazy value, is that what you're going for?
into their universe, yeah.
All right, all right, all right. So let's just go very. So I guess let's be very strange or something.
um,
No, I mean, let me know if I'm doing something you don't like.
I'm not looking at it right now.
Oh, okay.
Pretty much it's the same thing. It's like dividends.
Yeah.
Dividend quality is the most important factor.
Yeah, I'm doing here the dividend growth rate, same thing, then increasing. We got down to 21 now. I also put dividend yield above 2%. Um, let's see what else. Company performance, revenue growth. Do we care about that? We should, right?
We care about their dividend growth
Well, we do have that already. So then we don't care about the revenue
and
growth.
the payout ratio.
Oh, payout ratio, or was that? Is that still in dividends, maybe? Dividend frequency. Yeah, payout ratio, 5-year average we got, and we got trailing 12 months.
Yeah, both. And you want to do between 60 and 80%.
Damn, so more than 60 for both. Yeah, we got 10 now. Okay. We could just check
No,
that, right?
you
So,
60 to 80.
oh,
You don't
you.
want it to be more than 100
Oh, okay.
for obvious reasons.
Okay,
Yeah,
okay.
because we
Fair
don't
enough.
want
Fair
to have
enough. Fair enough.
health, picture of health.
9. Well,
Um,
8. I mean, not that much of a cut.
yeah, and then debt to equity
Where's the financial strength? Yeah.
between 0 and 2.
0 and 2. Okay. Or no debt.
And then interest coverage ratio.
Interest coverage ratio. Is that here too?
Yeah.
What is
No, it's
interest?
going to be in the financial health or whatever.
Yeah, that is financial strength.
Oh, yeah, yeah. Oh, uh,
Coverage ratio? Income with the gross. No, but this is coverage of dividends. Yeah. Okay. Never mind.
oh, it's interest coverage ratio. Okay, that's fine. We don't need to have it.
What, do we need
That's
any
fine.
valuation ones? Price to earnings or
Here's-
price? I mean, I guess the dividend yield tells us the price on the dividends because we care about the dividends, really, right? Do we care about
Sorry,
price to
what?
earnings here? Like I'm saying, dividend yield is gonna give us a valuation metric, really.
Yeah, you know what? Go to the analyst ratings tab
Oh, okay.
and then go to like Morningstar rating.
Just to have.
Morningstar fair value estimate.
Yeah, we just
Hold
have
on.
it.
No, but let me see what happens when you do. Oh wait, what the?
But this is whack. It's not even a percentage. It's just like the value itself. So we have
Yeah.
to just have it and compare it to the actual price.
Okay.
Anything else here? Or? No, right?
No, we're good.
7. I mean, we're good with that. All right, let's see. Let's do right away. Okay, wait. They don't tell us the price here though, so let me add it.
Go to price. Apply.
Oh, now we'll have it here. Nice, perfect. Okay. Look at that. So this is the most undervalued according to them. Well, they don't cover EDA, but yeah. And this guy, debt to equity of 1.28, payout ratio of set. They have the higher end of the payout ratio. The past 5 years too, they've been increasing dividends 5%. I mean, these guys look more interesting here. NEE, but they're I guess better priced.
Well, according to Morningstar, don't look too much into that. You know,
Fair.
they're more levered. What are these companies? Go to the left of the names.
Nextera, Portland, General Electric, or just Portland.
I know next.
Yeah, Nextera is the
Oh,
one that like caught my attention, but yeah, this is just Portland.
I don't know any of these companies.
Well, they just probably like this is Idaho, probably. You know, they're like different places. I assume. I don't know.
But I always thought that Con Edison
No, it's a New York
was
thing.
Is it?
Mm-hmm. I mean, the guy, it
Nah.
was Edison, right? So I guess maybe there are more cities than just New York, but I think they're mainly New York, bro. I mean, I can look it up. 1 second.
Yeah, I'm looking it up.
Oh, okay. The sun is toasting me right now from the back. No.
Oh, look at that. It is just for New York.
Yeah, I guess Edison was just doing all his experiments in New York.
Wow. You know, I never knew that. Straight up. Like I always thought that everybody in the country had Con Edison.
Oh shit. Yeah, no, I mean, I knew
Aficionado.
as much that wasn't the case, but I figured that maybe it'd be in another city. I mean,
So
I
you're
think it's
telling me that
everywhere in the world.
even National Grid, you're telling me that even National Grid is not national?
Oh, fair enough. But maybe they're in between. Maybe they're like the grid in between. These things are just like such a like a fucking government stooge. I don't even care about them. Like they don't even count as companies, really. Like,
Yeah, even National Grid is not national. And as a matter of fact, they're a British company. What the fuck?
oh, it's only in New York and Massachusetts. Oh wow,
Yeah, and Rhode Island.
damn. Yeah.
God, what a load of horseshit that is.
Yeah, so I guess it's also in the nature that because they control them, because they're considered monopolies or whatever bullshit, they cannot even acquire each other, probably. Like, you cannot have Con Ed buying Ida Corp, probably, or some shit.
Well, that's why yeah,
Like, I,
this is all very shocking to me because I always
okay.
assumed that like a utility being government regulated, I
Mhm.
assumed that the government regulating it was the national government, but it's actually the state government then.
Ah, that actually also, I didn't even think from that angle. Yeah, that actually is probably the main reason why there's one in each place. Because the state they're like, oh, New York kind of come here and buy our light company. Because it's like a
Yeah,
state thing. It's like as if a state control the other state or some shit. Yeah.
yeah, we really are like states in America are essentially just like the countries in Europe.
Oh yeah, for sure. People forget that this is like the U.S. is a federation, not a country. Yeah.
Yeah, there's
Yeah.
literally not. Yeah,
Yeah. I mean, it's because there's a lot of things, and there's also been a lot of recent things. Like the FBI is a very recent thing. There was no FBI. There was the U.S. Marshal, and that was, I mean, that didn't
yeah,
even have that much power. Like if you cross state lines, you were free from a lot of crimes, and that's why they did
yeah.
the
Back
FBI.
in like the 60s and
Yeah,
stuff.
it's like it was like the Interpol. That's what a U.S. Marshal was. Like it's like
Hmm.
who gives a shit? But yeah, it's kind of weird, like how much it has changed so quickly. Like it's yeah, it's like the '60s. And then like things like the
Yo, by the
taxes and
way,
stuff. But yeah, what?
I didn't tell you the update. So I remember I did the thing for the Bridgewater or whatever. I did the submission.
Oh yeah, how did it go?
So they were supposed to let us know now. Like they were telling me when you submit, they tell you that by the beginning of September they will let you know. I
Uh-huh.
got an email yesterday saying that they're like, we got way more applications
Uh,
than we expected to get, so it's taking a little bit longer. But
mhm.
remember we were guessing how many applications there might be, and you were saying like tens of thousands, and I was saying like max 1,000.
How many were they?
Or like
Millions?
no, there
No.
was bro, like
Well, yeah,
it was
millions is
even
a
less
lot.
than it was even less than I
Oh, what?
anticipated. They 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 were anticipating less than I was, in
Okay.
that they were anticipating less than 1,000,
Oh, wow. Okay.
and this they said they got more than 1,000. That's why it's taking longer,
Oh, okay. So it doesn't even get to 2,000. Huh? Wow.
type of thing. Yeah, isn't that crazy?
It is crazy. I thought more people would be interested in fucking a competition with. Yeah, but I guess what you're saying. There's not that many people in that world speaking English, and then that
Yeah,
will be
but then here,
spending
but
the
but
time.
then yeah, but that's the craziest part. So it says here
Mm-hmm.
we were we weren't expecting to receive over 1K from over 100 countries.
Hmm.
How does that make sense? That means that it was an average of 10 per country.
Well, you're doing an average there that I don't think is fair, but fair. Yeah, okay.
Yeah, yeah, I get it.
Like
More
if you
from the
just
United
have
States.
one applicant from one country, but yeah, yeah.
But then okay, what I would you know what I would
It's
say?
actually
What my
what?
theory is?
What?
I think that it's not exactly straightforward that they would all be from the. My
Well,
guess would be that they're mostly from India.
yeah. I mean, that would be actually my guess too. A lot of CFA candidates come from India.
I'm from India, yeah.
Yeah,
That's
yeah.
what I'm saying. It's
I mean,
like
India is the future, bro.
so it's like if you're saying 1K
And
from over
China.
100 countries,
Yeah.
that's just a crazy
I
concept.
think China might be high too because, like, the Ray Dalio loves China and shit, bro. He spends a lot of time there. Like, he has like a like I mean, like I think he has like institutions there in China and everything. Like, he gets along with the fucking leaders and stuff. So I'm sure it goes
Yeah.
the other way around too. Like, probably a lot of Chinese people like him and his
Right. So if you
company.
had to extrapolate, so now here's where my head's at, right?
Oh yeah.
The challenge is that if you win, you get 5K plus a job or an internship offer or whatever, right?
Mm-hmm.
My thing is like they're not gonna offer a job to somebody international.
Ah, look at you doing ratios.
Yeah, I'm boiling it down, right? I'm trying to figure out. I'm like, what's the max?
And
All right, if we're operating under the assumption that say there's 1,500 submissions, right?
yeah,
What percentage of those submissions are from the U.S.? Because
right, right.
if there's 100 countries, right?
Yeah.
That means there are at least 100 submissions, 99 submissions from countries that are not the U.S.
Okay.
So our base number is actually 1,400 if we assume
Okay.
that there's only one submission per each country again, it's over 100 countries, but let's just say it's 100.
Uh-huh.
All right, this is cope math, but
I know it's starting to get to that point. I'm trying to let it roll
no, but
and
just hear
see.
me out, right? Because
No,
if you're
yeah,
saying over 100 countries, it means that the minimum is one,
yeah. Fair.
which means
Yeah.
that at
So, I
least
mean, it's
100
100.
submissions are not from the US,
Yes, good. Yeah, okay.
right? And so if it's 100 countries and 1K submissions, that means 10% of the submissions are not from the US at the bare minimum.
Right, because 100 out of a
And then
thousand, assuming that it's around 1,000, 1,500. So, yeah, but whatever. It's not 2,000. So, yeah, it's a good estimate. And
it's
then also,
over
it's
one
probably not going
it's
to be
over
one submission
1K.
per country. So, it's a good estimate. Yeah.
Exactly. It's over 1K and over 100 countries.
Like,
So
it's definitely more than
assuming
10%. Like, it's a good minimum. Yeah. Like, it's definitely more
yeah,
than I would say. It's very confident that it's more than 10% that is outside the US. Yeah. Okay.
way more. I'd say way more than
I would say
10% because
two, but yeah. And we know that that's a
yeah,
good minimum for sure. Maybe two
yeah, in
safe,
China.
but yeah. Okay.
Yeah. So then I'm yeah. So I and then in my assumption, the biggest assumption is that they're not gonna pick a guy from a different part of the and
I
by the
don't
way,
know. I think that's a
it's
big
five
assumption, to be
winners.
honest.
It's five winners,
Yeah, but
right?
why wouldn't they pick someone from a different country and open the application to other countries?
Because nobody wants to sponsor a visa
Right, but then why would
unless
they open the application to the competition to another country?
I don't know.
Well, maybe it's because they are willing to hire.
I'm not saying yeah, but I'm just saying like
Also, you don't have to
like,
sponsor a
like
visa. You can just have them work from China or India. Like, I mean, that's the
oh
whole beauty
well
of this day
yeah
and age that you can just have them where they are.
yeah they have offices everywhere and stuff. Yeah.
Yeah, or even work from home. I mean, it's a beautiful thing to be honest. How like now you can
But
just start a
you
company
can't
and do like labor arbitrage without having to move
yeah
them around.
you can't have them work from home in a different country, bro.
Yes, you can. There's a lot of software companies that have policy like work from anywhere. Like work from anywhere. You can have a tax
Yeah, but
residence anywhere.
it's work from every
No,
tax residence everywhere or work from
no.
everywhere.
Work from anywhere as in you can reside anywhere. Like they you do have to do something. Like it's not like it's just very easy. You have to do some type of like administrative like backflip to have be able to pay that payroll in that country. But I'm sure it has
Yeah.
become very easy to do that to the extent like now maybe I cannot do it maybe easily. But if you're a company that has more than 100 million, like it probably isn't that hard to set up like some type of company that you can set up in whatever country and then pay the payroll there, and it's not that much of a cost. And if you're a huge company like Bridgewater, definitely isn't an issue. They probably already have an office there, especially if it's India or China. So you know,
Yeah.
so yeah. I mean, I don't think it's that clear that they wouldn't hire somebody from outside the U.S. But I do
I think it's
think that they
depending
will
on the
hire
roles.
more likely. Like they're more likely to hire somebody from the U.S. I'm not saying I'm saying I
Yeah,
don't
like it's a lot of
disqualify, but I do think they would rather have somebody in the U.S. and in England because even if it's just
I
because of
think
the language.
there's like a premium, there's like a associated premium. Like it's like if a guy from India
Hmm.
has that much of a better submission than every
Yeah,
possible US
yeah,
can,
yeah,
that's their hurdle.
yeah, yeah.
Whereas like the US applicants don't have that hurdle.
No,
That's what I
I
think.
think so. I think so. Also, plus the fact that the U.S. I think has the best labor laws in terms for companies, like to be able to hire and fire easily. Well, maybe not the best in the world, but up there. So yeah, like you'd rather hire an American because you can fire it easier than you can hire French. You know what I'm saying? But I don't know
Yeah.
about Indians or Chinese, like how it works. Probably not too hard either. I don't know. But yeah, I do think it's good odds just on the basis that I thought it was way more winning many more applicants.
So there's companies that actually do what you said.
Ah,
I
right.
think they
They manage the
there's
payroll for you, like
yeah.
remotely. Yeah.
Yeah.
I mean, yeah, it is an. Yeah, I'll probably do like if I know when I get to the level in the like video game studio and stuff. It's like for programming and stuff, it makes more sense to hire somebody in India.
Well,
It's
you're
just,
just gonna use contractor agreements.
yeah,
That's all
yeah,
the
but
difference.
I could do
You
that
don't have
with India. But I
a
mean,
payroll.
eventually I could hire somebody. But yeah, like I meant contracting
You can do it with
agreements.
anybody. Like yeah,
But even
for
that
what
doesn't make sense in this day and age. Exactly. Like it's just better to
yeah,
do labor arbitrage and on top of that, never really hire anybody. Yeah.
you have contract work.
Yeah, I like the idea of like there's this guy that wrote like it's like a Bitcoin guy that loves like all the blockchain stuff and the idea of doing like bits, like you put a contract and it's kind of the same thing as how the blockchain works for like you put out a block and then people mine for it or whatever. I don't know if it works for every blockchain, but for Bitcoin, right? And then everybody's
Mhm.
competing and whoever solves the problem the best or the quickest or whatever gets it. So something like that for works in which you just post you're not looking for a worker for a contract. You just post the thing, and you're like, whoever submits the best one gets paid. You know, and then you select on the
Uh,
basis of that. So it's like, I mean, it is.
yeah,
It's like I don't know
that's
how
fine.
actual, like if people would be willing to put the time to work on something without a contract. I guess that's the main
Without
thing.
a promise of pay, I don't think so. Yeah, like it
Yeah, I wonder how
depends on
that is. No, like I feel like I'm getting something wrong from what I'm explaining from him because I don't think it was that blunt of a strategy. Because that sounds like I just said it. I'm like, yeah, then probably nobody will submit
well,
because
the
like,
idea, I mean, it is in practice, it happens because of what you said. Like Bitcoin, that is what Bitcoin is. Bitcoin mining is just that. It's like you might have like a huge
yeah,
facility, several miners, and never make any money. I mean, it's
yeah.
unlikely, but
Hmm.
it's still possible.
Yeah, but I wonder how that plays out. I mean, I guess for an artist, it could play in the sense like you're still the owner of your art, unless I contract it. I don't know. I don't know. But yeah, the idea of open contracts instead of closed contracts. But yeah, I don't know. I gotta think more about it, if anything. But it does sound interesting how the labor markets are evolving a lot, in which is like because of all these restrictions that the government has put on every time you're trying to just get a worker, you gotta do like you gotta buy them a house, and you gotta have the retirement, you have like social security and shit. It's just the disruption there is just not hire anybody. But anyway, utilities. Are we interested in utilities? Now that you know they're like a state-run company.
Suppose not. I don't
I mean,
know.
let's see this next there is the only one that kind of stands out.
The thing about it, about utilities, is that like they're entrenched, and so like the safety of capital is insane.
Yeah, but
Like
then yeah, I guess let's see. I mean, what is the dividend yield on these things? It's like not
like
even
if
that.
you're operating
It's
under
like
the
a
assumption
savings
that you're an
account.
investor for years, then it's like
Yeah, but then
it's
it's like
just
a
one of
savings account. It's better, I guess, than a savings account because they provide. Well, let's see if they don't. If they provide a more
they have
stable
to, yeah.
dividend than a savings account. I don't think they have to.
They do, and they're what's the word? They're productive capital. It's like I mean, yeah, I guess so is debt, but like still they're growing both their income and their distributions. So you get capital appreciation and distributions that are growing from a company that's pretty much established by the state government or whatever, you know?
Yeah, okay, so these people are more like renewable energy stuff. That's why next there. Okay.
It's slow growth, it's slower growth than perhaps traditional equities, but
Right.
the risk the risk is so minimal because it's so
Yeah, and
entrenched.
look at that dividend growth. That's pretty fucking good.
Yep.
That's an average of 10% every. Well, I mean, we did check that in the screening. Like, right?
Did we check to see if waste management is a utility? Or is that considered a
No,
utility
we
or
didn't, but it should be. Yeah, I mean, it's just they're the best one at this. They've been growing 11% on a 10-year basis. And the other one is this one, WEC, which is at 8%. What do they do? Yeah, I'll check the waste management in a second. The subsidy provides for natural gas access to renewable energies. These are Wisconsin, Illinois. These are more local, I guess. So this is more distribution than actual. No, they also generate, yeah. And then their dividend also grown, yeah. I mean, look, I don't know. It's like I get it, like they're good investments, but it's I guess it's boring. Is I guess what I'm getting at that I guess I don't want to say. That I'm like, what the hell am I gonna do with this? Like, what am I?
what do you
What
mean?
will we do to value this? Like we could buy any of this, I
What do you mean?
guess.
What is good of value?
Like,
It's
I'm
just
like,
you just
okay, I just buy it.
well, yeah, you value it. If it's undervalued, you buy it, and then step two would be profit. And then if it's overvalued, you don't buy it. And
No,
then
I
step two
just
would
mean
be
like, wouldn't like, isn't it already pretty efficient market? Is what I mean. Like, how can you get the valuation of this wrong if it's like so clear as you say, right? And if it isn't, then what is the delta there? Like, what can go wrong
well,
with buying
it'll
it?
be wrong. It'll just no. It'll be like it's sufficient, sure, but it'll still be wrong. Like it just won't be wrong to a degree of which like you won't find an intrinsic value that's like 30% less than the current market value. But
Yeah, that's I
if you
guess.
get a if you
Yeah.
can find a really good estimate for your intrinsic value, then you can just add to it every time it goes down. Or like in this case, if you didn't want to do any
Hmm.
um, contribute dividends to reinvestment versus non-reinvestment when you think it's undervalued versus overvalued.
Hmm.
And yeah, again, like, dude, this is the kind of thing that like it's if your perspective is like 100 years plus an infinite holding period, then These are the type of
Right,
companies you got to look at.
because they pay a good dividend, they have safety of capital. I don't know.
Yes, and they're gonna
I
grow.
just don't like that they're
Like
so tied up to a government that if the government decides to cut the price of lighting, they can. And then I don't know. I don't know.
if you're an investor in that company, but you're also I mean that's yeah, if it's like a local thing, then
Also, like, yeah, you see things like this, like, why?
you're
Why does the
covered.
company just go down so much? Like, well,
You're
on the
covered
basis of
by
what?
if you're a New York resident and you invest in Con Ed, any any falling revenue from reduced costs of electricity would benefit you in different ways.
Well, okay, but then the argument there would be that you already invested in Con Ed.
Exactly, yeah. It's bad.
Okay, so then you should invest more.
Yeah, type shit. But you're offsetting in some ways. You're kind of offsetting your cost of electricity by investing in Con Ed
Okay, look, I mean, I'm not interested in the sector. If you want, we can add.
in a very convoluted way. No, we don't have to add it. I'm not
It's just I don't know
like
what to do with it,
like
and
devil's advocate,
I
you know.
don't really, I don't know
Well, you
what to
keep saying
analyze
that. What does
here.
that mean? You don't know what to do with it? Are you? What are you? You're not playing with these things. Like, what are you talking about? It's
Like
not, what, like, what, I don't get it.
I
What
don't know
you
how
know
to
to do?
distinguish one from another apart from like like the analysis of a company like this. I would have to look at like what is the trend of use of electricity in Wisconsin. You know what I'm saying? Like I'm not like the
Yes.
company doesn't do anything. Like it's just they distribute
So you don't
electricity.
have to do any of that if you just are. You just can. If you assume what you assumed before that those markets are efficient because they're so regulated, then the cheapest one will yield the greatest return.
Well, that's
All
the
else
I
equal.
don't know. I mean, maybe the cheapest one is in fucking a city that that is dying, and now it's like you know what I'm saying. Like now I gotta analyze like social dynamics of like I just don't. I don't know. It's like I don't know. It doesn't sound like I'm not analyzing a company. I'm analyzing like a social thing. I'm analyzing like a state government. I'm analyzing like is the next governor of Louisiana gonna like tell this company to raise prices or not? Like I don't know exactly
Yeah,
how it
I
works.
think, but I don't know. I think all companies kind of are beholden to that sort of thing. These
But
ones
not
more,
as
obviously.
much. Yeah, that's what I mean.
Yeah, yeah, these ones more. All right,
It's
yeah, we don't have to. Yeah, we don't have to. You don't have to add it, bro. I
Yeah,
think
plus the
it's
fact is like all the thing of like now if the politician is saying, "Oh fuck, wind and energy," like what just happened with this company that like sued Trump for like 1.8 billion dollars because they Trump was just like, "Ah, we're not gonna honor the contract from Biden on building a bunch of wind." Like it's just like it's all very I don't know what to do with it. It's too government related.
all
Okay,
right.
but let's check the thing you were saying. Is waste management a utility stock? I mean, company, whatever. Oh, okay. Wait, oh, waste management is like a company? Okay. Okay, so traditional this by water, power, or gas. Well, waste management provides critical public service. So what is the industry? Its business is considered recession resistant by in regulated industry. Okay, but what is it? Okay. What is industry?
Sleepy
Environmental
Dawn
service
is
and waste management industry. Okay, what
trending.
the fuck is this? Okay, I guess I could just search that stock and see.
Sleepy Dawn is trending.
Commercial services and supplies. In what world, bro? Is that a commercial service?
Did you have a good time, Sleepy Dawn?
What are you talking about, bro? I feel like we can leave the next sector then. It seems like we're about to hit the 3 hour mark.
Sleepy Dawn.
What are you talking about, bro?
Sleepy Dawn, bro. Talking about Sleepy Dawn.
Okay. Who the hell is that? Sleepy Dawn.
Oh man. All right, so why don't we look at those companies you sent me for a little bit till
Well,
we're done?
okay. Yeah, we have 5 minutes, but yeah. Hmm.
We have 11 minutes.
Oh, we
now.
got 11. Yeah, I was just looking at the stream. No, anyway,
Uh-huh.
what company though? What companies did I send you? Oh, the
Okay.
Argentinian ones.
Yeah.
Sure. Gao.
You give me an Argentine bank and an Argentine
Look at that.
what
Look
was
at
it?
that. Price to earnings of 5, I think it is now, because it depressed even more recently in price.
His
It's
forward PE is
6.
5.
Look at that. Anyway, what's the other one you said? YNL, but I don't like it as much because apparently it's all government owned. Although I guess it's just I'm supporting like Millet, I would be happy with that because they might sell them or they might. I don't know. Anyway, YNL is the other one. You want to look at them? What do you
Yeah,
want?
do you know that they're flirting in America? They're flirting with an idea of making Intel government owned.
Mm, because of
Did you read
China?
about that?
No, I didn't read
Yeah,
it. Damn.
they're considering nationalizing a portion of Intel.
Is Intel that cheap? They
Oh
don't
yeah.
care. Oh yeah. Well, that would be a reason. Oh, do you see the thing with Oracle, by the way? Of course you did,
hmm
right? Yeah, okay, that's wild, bro.
Yeah. I mean,
I
I
mean,
didn't understand it at all, to be honest, but
no, it's the biggest cloud contract ever. 300 billion.
yeah, I get it.
Yeah, I mean that's. I mean, it is
Over how
over.
many?
It is a lot of money that they pour into the market. Like it is 35% appreciation on the stock is kind of too much, but I get it. I get why. It's like the same reason why Nvidia went up. Only that this was more of a surprise, so it happened all in one like shot.
Yeah, but I'm saying like 300 billion.
Mm-hmm.
First of all, how long is the contract? I'm pretty sure it's more than 10 years.
No, there's no way. Let's see. That's a long time, bro.
Mm-hmm.
Oracle Open AI contract. Are you gonna let me read it? No,
Yes.
of course not. They're not
Oh,
gonna.
just go to archive.md, bro.
All right. Ah,
And then copy and paste the link.
wait, what do you mean? Oh, I
No.
don't know what I
Yep.
just
There you
did
go.
there. Okay.
Yeah, you did it.
People familiar with the might say a massive commitment this far as strips. Okay. Okay, do I have to go to the press release maybe? Okay. Starts in 2027, first of all. So it doesn't even start for 2 years.
Okay.
It's a money losing startup. I love how they
Yeah.
define the Wall Street Journal. OpenAI is a money losing startup. There was this
Yeah.
generation that
There's a guy on
revenue.
Twitter. There's
That
a guy
guy
on
does
Twitter
a.
that like he won't shut up about how it's like they're never gonna get to a point of profitability, these AI companies, because it takes
Keep
too much money.
spending. Yeah. I
Yeah.
don't know. I don't
Less
know.
than 1/5 of the 60 billion
I don't know.
it will
No,
have
they
to
have to
pay on
pay on
average.
average every year. So wait. So they said wait that can give us the duration. If it's
Yeah.
300 divided by 60, it's a 5-year contract.
No,
Yeah.
less than 1/5 of the 60 billion.
No. They're saying that these people making revenue, OpenAI, less than 1/5 of the 60 billion they'll pay every year, which means that the
Okay.
contract is a 60 billion a year, which is a
5
5-year
years.
contract. Yeah.
Mm.
It's starting 2027. I mean, again, I guess the thing that you could
How are they
say
gonna manage that?
against buy an Oracle is that OpenAI is not gonna honor that contract.
Yeah, how are they gonna? How are they gonna?
I mean, it
Are
is
they
a
gonna
bit. It is a bit of like
10x
you're signing
revenue?
a contract to start in 2 years, but it is a
Yeah,
contract. Like, because they gotta build it. I
60,
mean, they have to
60.
honor.
So what we're saying essentially is that if the current revenue run rate to be very like lenient towards OpenAI, let's say they do 100% revenue growth in the next 2 years,
Yeah,
they'll have
more.
40 more.
No, isn't it? I mean, if they're gonna
Right.
be making
So
60 billion
let's
from these
say
people, what is the
it,
like revenue of these people? Let's see.
what are you gonna? What?
I'm just gonna
The
check the revenue this year, right? And then we're gonna assume that they're gonna be making 60 billion from OpenAI in 2027 in revenue, right?
Oh,
Isn't that a
you're looking
good?
at round. I'm trying to tell you that
Yeah, okay.
it's
It is
not.
100. It is 100% kind of thing. Because in 2026
No,
they probably
no,
made 60 million.
not
60.
what I'm saying. It's not
Oh.
what I'm saying though. I'm saying, how is OpenAI gonna pay if
Got it. My bad. My bad.
if they grow their revenue 100% for the next 2 years? That means that in 2027 they're at 40 billion in revenue.
Mm-hmm.
That's less than
Yeah,
the
like just
amount.
on a revenue basis. Right, but that's why,
Yes.
I mean, they did hire a lot. Like I was reading an article how they grew their go-to-market team like insanely from like I think it had like 7 employees to like 150. Like they're targeting companies now. And if they continue to figure out the AI and then they make it like an agent that they can deploy in a business to do things for the companies, then it replaces employees, which means all these companies will hire OpenAI at a much higher rate than what the subscriptions from like normal users are. Like the whole thing, and I assume that's also why they're signing this contract, is that they know they're gonna need a lot of compute, and they're just gonna keep like the money that they get enough from customers is just to train the model, and they're getting a lot of input from these users to train the models. But then the real money is not gonna be on like individual subscriptions. It's gonna be on.
Yeah.
And then they have an AI that is already trained, and then they're just
Yeah,
gonna
but
deploy in
But
businesses.
Palantir already does that.
No, but Palantir is
And
partnered with them. Like you know what I'm saying?
I know,
Palantir,
but
like people confuse that. Like Palantir doesn't provide AI itself. Like Palantir what it does, it makes a digital twin of your business, so then you can put
yeah,
AI on
yeah.
top of it very well, like better than any other company.
No,
So
but what I'm trying to explain is that Palantir's business model is that it partners with companies, and those contracts are
mhm.
not as big as they're not like more than 100 billion. They're 10 to 15 billion dollars per contract
Well,
over
yeah,
a
but
number of
that's
years.
first of all, I mean, the Palantir thing is different because the margins are much lower than what OpenAI would be once you have trained the model. But
I get it, but I'm trying to tell you that like
yeah,
the
okay. So
fact
even if
like
it's 10 to, but that's per company,
60
right?
billion is a lot of
It is.
expense. It's a lot of yearly expense, bro.
It is, but it's also like if you calculate the fact that OpenAI already makes 10 billion just mostly out of individual users, and then, if
No,
you just
wait.
have
Oh, 10 billion from individual. Yeah, yeah, sure. 10 billion from
like
individual
mainly
users.
it's individual subscriptions. Like they have 100, what is it? Like 700 million active users per week. It's then you add all businesses on top of that and the growing use of like just normal people. It just
Yeah, and
I think
then
it's definitely
realistically,
achievable.
yeah, I don't. It's like you don't even. You still don't get to that, bro. I don't think you
Are they
understand.
public
Like,
OpenAI? No, they're not. I mean, that's the thing. We can't even
there's
check.
like probably less than 5 companies or like less than 10 companies in the whole world that have 60 billion in costs per
Nah,
year.
I mean, well, yeah, yeah. I
Yeah,
mean, yeah. There are very few. Yeah, yeah, fair.
yeah.
But
There's
I don't
less than
care. Like,
five.
what does it matter? What does it matter that
Well,
there's
it
very few?
matters. It's unsustainable is what I'm trying to say. Is that they'd have to get to a, they'd have to become like the most valuable company in the world
That's
pretty quickly
I think that's what they're
to
going for, bro.
justify, yeah, to justify paying 60 billion a year just just in cloud service costs, by the way. That's not the entirety of their, right? Obviously.
Yeah,
So,
I
I don't know.
assume that's what they think that they will be the majority of the cost because once you have a trained model and then it retrains itself, you don't need R&D people. Like once you get critical mass on an AI engine, it runs itself, and all you gotta do is give it fuel. So I think that it makes
Yeah.
sense why they would do the like, and it makes sense why they would sign such a big contract so that Oracle can build all this shit with the assurance that they will, well, whatever type of assurance that is, that they will get paid. And the fact that probably Microsoft is like backing this deal in the sense like they're like guaranteeing that that they'll pay this thing because I don't think if
That they'll
OpenAI
pay.
did right. So then because it's like, and that's why I think the big contract because it's like they need somebody to really build out and Oracle, I assume, because they have good, like, they've been around for enough that they can have good deals on, like, the energy contracts and the government permits and whatever. That's probably
Is
why they
this
went with
just,
Oracle.
you know what I'm thinking about?
What?
Imagine what Amazon was charging them.
Ah, yeah, fair. Yeah, I mean, definitely
Must
there's
have
that
been
for
fucking
sure.
obscene.
Yeah, they're not the only ones on the table, right? Yeah, probably not.
Of course they're
I mean,
not.
this is
Yeah,
a
of
big
course not.
country. Also, you know what's interesting too? Microsoft provides cloud, computing.
Yeah,
So
in how and yeah,
yeah. So I think maybe it's becoming kind of like they're just giving the bone to Oracle type of thing. Like Oracle, because this is one thing that actually I read in an article about this stuff, which is that Oracle is much more efficient on a cost basis than any other cloud computing provider. Like more efficient than Amazon and more efficient than Microsoft. Mainly, I think because they don't own the real estate, like they don't buy the real estate. So I don't know exactly what they do to figure this out. So I guess the whole thing is Microsoft was like, we don't want to do this for OpenAI because too high a risk or something. And then Oracle provided a good outing, which is like this company that already wasn't doing that great.
yeah. But then it's like it kind of proves the other point that it's like if this cost is the cheapest on the market,
Ah, well,
then this whole
then
AI thing is
OpenAI is
not
gonna go to
sustainable.
shit.
Yeah, like how is that even sustainable that they're going to be paying 60 billion per year in cloud computing costs? Like I don't know,
Again,
the whole thing is insane, bro.
it is insane. I mean, there is a big bet on the fact that this will be like the brains of everything. Like OpenAI will be, or any
Yeah.
AI will be the brains of every business, every interaction. It'll be just kind of this interface. Instead of the internet, you just talk to ChatGPT, and ChatGPT takes not even the internet, a computer. Like it'll just be like, yeah, the new interface for yeah, human to machine interaction. So then it's like everywhere. It's in credit card payments. It's in booking of flights, of trips, of any question you have, and getting new milk in the fridge. So it's like what you said. It's like they are predicting to be the most valuable company in the world. So yeah, I don't fucking know if that it's a reasonable or a crazy prediction.
Global AI spending to reach 500 billion by 2026.
Google on what? On revenue?
No, global AI spend.
Ah, yeah. I mean, but yeah, again, these predictions again. This is the other thing too. I saw a video about like, oh my god, like these people got together, these AI experts or whatever, and made like a document about the most probable outcomes for AI, and it's like all these assumptions that they make about AI is gonna become super intelligent, and then they're gonna shut it down, and then China's gonna copy it. I'm like, bro, there's so many variables that are like not into account, like, and that's so irrelevant to, or like that make AI irrelevant in that sense, like.
Yeah, okay,
Like,
look,
oh, this
look,
works out in a
look, look,
bubble, but what?
look, okay.
Hmm?
In
Ah,
2026,
hmm.
some analysts predict that AI data center capex could exceed 1.4 trillion by 2027, right?
Okay.
And then I looked up that what's the TAM of AI, and it
Ah,
says AI
quadrillion.
market size will reach 1 trillion
Oh,
within the decade.
that's not that big. I thought it
So
would be bigger.
on a TAM basis,
Yeah.
it's not even
Oh, I
profitable.
just saw what you did there. Right. You're saying that in 2027, the expense is going to be 1.4 trillion, and the TAM on a 10-year basis is 1
It's one,
trillion.
not on a 10-year, but before 2030. So it's on the
Yes,
same I
same.
the
Yeah.
same time.
Even if,
So
yeah,
by
okay, yeah, but
2027,
still.
TAM will be a trillion, but capex will be 1.4.
Yeah, yeah.
Yeah,
I guess, like,
it's
what is the time
crazy.
horizon, right? When would they be
Yeah,
profitable? How much market do they have to capture? But I mean,
I
the
think
time of 1 trillion sounds very conservative to me. Like, doesn't like what is the revenue of Amazon, for
yeah,
example?
it's not a trillion. I'll tell you that much. It's like a
Right.
hundred billion.
Oh, really? No, it's six hundred
Nah, it's
seventy
more. It's like
billion, bro. Like,
yeah,
and they just do like packages and cloud. Like, okay, I'm not trying to dismiss that, but I'm just
they're
saying,
the
like,
leader
AI
in
would be
cloud.
much more like pervasive. Like, it would be
Amazon
many more places.
Amazon controls 40% of the total addressable market of cloud worldwide, and they don't even have $1 trillion in revenue.
Right, but again, I think that's just one part, whereas AI would address many parts of like many
There's not enough
industries.
money in the world to get the TAMs that are
Yes, there
that
are,
much
bro.
greater than a couple trillion. No, bro, what are you talking about? A
No.
trillion? A trillion. What's the GDP of America? Is it how much is it?
Let's see. GDP of America.
30
30
trillion.
trillion.
Okay.
I don't
All
even
right,
know
I'm
how this
expecting.
is calculated. But I don't know how this is calculated. It's like, damn, China is 18 trillion. Like, I don't think these metrics are right. How's China that much lower than US?
That much, if I'm being completely honest with you. I was in my mind thinking of a ballpark figure of around 10.
I think they have more debt. Like, no, didn't we just check that the debt is higher
They
than
do.
10?
They definitely do have more debt, that's for sure. But like still
Yeah, yeah.
pretty crazy. $29 trillion of productive capital is happening
Is
every
that
year
what
in America.
is that what GDP is?
That's fucking insane. What's that per capita?
Goods and
That's like,
services produced. Yeah. Per capita,
yeah,
you see.
this is just value of the fucking workers and shit. GDP per capita. $88,000.
Yeah, let's see. I'm looking at the list.
That's crazy. Every American. This is including the children, no? Or is
Well, Monaco
capita
is number one, actually, with
Yeah, I mean,
256,000 per person. Luxembourg, Bermuda, Ireland. Ireland is up there. It was 100,000. What did you say the
does
US was?
does 88,000,
Yeah, here it
86,000.
is. Yeah, 85, 86. According to the World Bank, Ireland is 107,000.
Like, look at Canada, bro. Trash. They're not doing shit over there.
Ghana is at 54,000. Where is Spain?
Mid. Oh, yeah, yeah, yeah.
35,000.
Yeah.
And where is Greek?
Greece is higher. Greece is higher.
No, it's not. It's at 24. Well, it's 10,000 lower, so it's pretty much lower, yeah. Argentina's at 13,000.
Does that mean, you know what that
Russia is
means?
below. This is why it's like, I don't get like these metrics. How is Russia so low? Like, there's no way,
Because it
but
has
these people are
more.
doing fine. I don't
Nah,
know.
it's just
But they do have a lot of people, I guess.
per
I don't know.
capita
Yeah,
for it.
yeah, yeah. China's 13, right? They have a lot of people, right? Yeah.
But for Greece, that's kind of even more damning because there's not that many heads out there, bro. Yeah, bro.
uh,
But you
oh
know
my
what's
god.
insane?
What?
I think this means that if there's no government,
Mhm. Okay.
then each citizen should make this amount.
I don't think that's what that
You know,
means at
it is what
all,
it means.
bro.
What?
What do you mean? If there's no government, it will be more like the opposite. It will be way more difference. There will be a lot of richer people that are richer. Not a lot of like richer people will be richer and poor people will be poorer, which I think is wrong.
Oh yeah, well yeah, but I'm saying like if there was no government expenses.
Ah, okay. I thought you
So
meant if there's no government. If there's no government expenses, well, on an
if there's a
average,
perfect,
yeah, it
if
should be
there's a
that.
perfect socialist, yeah, if there's like a perfectly socialist
Yeah, yeah, like the opposite, right?
country
Yeah.
that operates under no government, but every citizen is fully committed to operating under a socialist ideal.
Yeah, no government
And,
expense, and then everybody kind of distributes the wealth equally. Okay. I don't
yeah,
know where we're getting with
everybody
this.
makes this, everybody makes this,
Yeah.
and then everybody contributes a portion of this
Right, which the
to
other
the
thing
big
too, if we go to
thing.
US debt clock, it's like what is the debt per person? Because like we can even check out what is the debt per tax
Yeah.
right. It's like we're
It's
definitely
like
over
those
leveraged. It's
it's those
320,000.
it's
That
like
no no
those
no no no
TikToks
no.
of like
Per taxpayer. Okay, that per citizen, which would be the one for per capita, is 100,000. So 109,000. Yeah, so it's like every citizens right now is $15,000 in debt.
hell yeah.
Nice.
Let's go.
Yeah, that's not sustainable at all, bro. What about
Yeah,
the
they're
interest?
not 15 they're $100,000 in debt, but their
Right,
debt to
right.
income ratio is 100% plus.
Well, then there's the thing too. It's like that is not the same as GDP because GDP is domestic product, right? So it would be more like the income or the revenue. The revenue would be like the. So then it would be
Yeah,
more like we
revenue.
would have to compare, I guess, the interest payments, no, to the GDP. Is that GDP is a
Yeah,
it's a
yes, yes.
period metric, right? It's not
It's not
like an
just
asset.
well, if you're doing it on no, it's revenue per citizen, and
Right.
then
So then we gotta take
if we're
what
if
with
we
the
were to
interest on
take
this.
the entire
what's it called? You would have to look at the budget
Oh,
to
here it
get the
is.
actual
Interest on
breakdown.
debt. Right, but how can I check this per?
Right, but it's not just interest on debt, right?
Okay,
Because it's
okay.
everything else too. It's like everything that you need to function in the country. It's like the budget is the better. If you look at
Ah,
the U.S. budget and then
U.S.
divide it by
federal
the total amount of
spending.
people,
Right,
exactly.
that's what it
U.S.
is.
federal.
U.S. budget deficit. Wait, but let's just look at the federal spending, which is
No, yeah, not the budget deficit,
million,
just the budget.
billion, trillion. 7.4 trillion, right?
Is what?
7.44 trillion is the federal spending. Wait, is this the
Okay.
total amount though? One second. This is a cumulative thing.
It's yeah. You have to look at it.
Yeah,
per year.
I just look it up. U.S. federal spending this year. Last year. 6.7. So it is. Okay. So it is maybe that. It is 7.4 trillion. It's not a cumulative thing. Okay. So
Right. So 7.4
7.4.
trillion
Yeah.
divided by the population of America
Which is
is
what?
what?
Yeah. I don't know what the population of America is.
Yeah, no, we're operating at a yearly profit because if you go back to the big numbers, our GDP is we said 30 trillion and we have around 7 trillion of expenses. That means 23 trillion profit for the whole country. Divide that by the total number of citizens, which is around 330 million,
Hmm.
and you get a number, or on a percentage basis, it's like 30%,
Hmm.
or less even, like 25%.
Mm-hmm.
So the take home of every American theoretically would be uh, 75% of 85, whatever that is.
75% of 85. Yeah, I'm doing. Yeah. We were like 60,000.
Yeah, something like that. 50 something.
64,000. Yeah. All right.
64?
Yeah, 63.7. Yeah.
How?
3/4 of
What?
85.
Is 63?
Yeah,
Oh
64.
yeah, yeah. Yeah, I'm bugging.
Okay,
Yeah.
so yeah, that's not bad. Yeah, I mean, that's the other thing too. It's like, I don't think the problem was much. Yeah, I guess, yeah, is there a problem with the debt in the U.S.? Because it's like
Debt
you're
service.
not. It's like it's debt on the assets of the United States, which are worth way more than 37 trillion, because the U.S. is producing 30
Our
trillion every
interest,
year.
our interest coverage right now is adequate.
I guess the whole thing is that it's like you cannot compare. In the same reason why it's the U.S. national debt is not the debt of the citizens, it's the debt of the
No.
government, and then the government has a tax revenue. So I guess that's the issue here. I suppose that it's
Yeah,
like
we're not using
there
entirety
is
of
not
GDP is not
GDP that
used.
covers the debt; it's the tax revenue that covers
No.
the debt.
We were
Right?
looking at it on we were
No,
looking
yeah,
at
fine.
it as if it was like a citizen level.
Yeah, but at citizen level, right? It's like, yeah,
On
that's
a
no,
citizen level,
I
it's
know, no.
productive.
For what we were doing makes sense what we did. I'm just saying for whether the U.S. government has too much debt or not. What we should be
Yeah,
looking at is
the revenue is tax revenue.
yeah, which is now I'm looking at it here. The revenue per citizen is 16,000, and the debt per citizen is 100,000. So they're very levered because they will need to raise way more taxes to service
Yeah,
the
and
debt.
also, by the
Right,
way,
right.
16,000 per citizen, and then the spending is the thing because it's not just interest, it's also everything else.
Yeah,
So
yeah, yeah. I mean,
we
this.
said we figured out that it's 25%, it's like 20,000 per citizen is the
Yeah,
spending,
yeah, yeah.
which means that
Yeah, the
we're operating
deficit
at a
per
negative
citizen, deficit per citizen is on a tax basis. Yeah, it's 4,000. Yeah,
on a yearly basis. So we're losing
yeah. Each
$4,000
right,
per
but then yeah,
person.
I guess the government, like yeah, the argument of a socialist would be, well, that citizen has way more money that they're not giving to the government. So we would do the
Yeah.
calculation that we did earlier, which is like actually every citizen is benefiting because every citizen is making 64,000 a year. So we gotta take more of that
Yeah, the debt
64 to pay
the
the
debt is
debt.
productive on that level.
Right. Yeah.
The problem is that it's the servicing of the debt that's impossible theoretically.
Like who's gonna lend the money, right?
Yeah, for going forward, you know.
Yeah, that's actually a
Like
good
as a
point.
country, we're making good use of the debt, which is obviously why we've given out so much of it. But but like yeah, unless
Yeah,
tax
that is the
rates
risk. So
move
who's gonna
to
buy the
insane
debt?
levels, then it's impossible. It doesn't
Yeah,
work over the long
yeah,
term,
yeah,
you know. Unless you just keep getting more and more indebted, but it's like who are you getting indebted to, you know? It's like
yeah.
those
Right.
TikToks where it's like we should just give all the debt to one guy and then he just
And then kill him.
and then, yeah, that just solves the
He's
debt
like
problem.
the
It's like one guy.
economical scapegoat.
Yeah, we give him like a nice monthly payment, and then we give him like on a personal basis, we give him everything he needs. It's like he takes a deal where he has a monthly payment of like $1,000
Uh-huh.
into perpetuity, like it goes to his children and his children's children and his children's children and stuff.
Uh-huh.
But then we treat him like a king. We like he's like, you know what I'm saying? We get him pussy, whatever he needs, we get it for him. You know what I'm saying? He like he's just the
Mm.
man. And everyone knows he's like a celebrity. He can be in movies and shit. Whatever he wants to do, he can do it. But he's also just $30 trillion in debt or whatever.
$30 trillion.
Somebody get the president on the phone right now.
Yeah, there's a cool like thing that they have here on the US debt class. It's like US hidden wealth. And they're like looking at the actual assets of the US. I mean, of their estimate. Precious metal reserves, 1.2 trillion. Mineral reserves, 9.4 trillion. Real estate, 76.6 trillion. Land, 25 trillion. Stock market, 52 trillion. Recapture assets, whatever that is, 7.6 trillion. Therefore, the total hidden wealth of the wealthy United States will be 175.6 trillion. Therefore, if each citizen owned a share of the United States, they would own a share worth $514,000. Right. So then that's where you compare debt per citizen of 109,000 means that the debt to asset ratio of a citizen in the United States will be 0.2. Pretty good. We should lever more.
Fuck off, man. All right, let's end the episode, man.
Yeah, that's the end of the episode. All right, thanks everybody. Let us know in the comments if you think the US should go into more debt or less debt, and who should own all the debt of the United States.
Yes.
All right,
Don't forget to smash the subscribe button, smash the
do
like
that.
button,
Yes.
smash the dislike button,
No.
smash your screen.
No. Sure, if you want. But thank you for being here. God bless you and see you around.